A very good morning to you all. Welcome to Trade Live with IG. It is Tuesday the 12th of August. It's CPI day and it's the big Ronnie day.
It's my favorite day when I'm here with you, Rich.
Likewise, sir. Likewise. Why have you got so many clothes on?
Because to compensate for your lack of clothes, I think the viewers at home should be very happy that the camera doesn't show the full body.
Mate, it's 32 degrees today.
It didn't feel like it this morning when I got out, but you know, you and I, we get up in different times. Some people roll out of bed, come in at last minute. Other people, they've already been to the gym by the time you get
Some
up.
people are still watching this in bed. Don't make them feel bad.
That's true. Sorry, Mama McDonald. We haven't spoken about her in a while. How is she doing?
She will be joining us. She very much enjoys your stories.
I do miss and care for her very much.
And my sister as well. My sister prefers Mini Cooper. But you're up there. Didn't say she disliked your rambles.
They pat you on the back so they know where to put the knife, mate. That's how it is.
Right, what's coming up on today's show? We got myself and Ronaldo here first thing in the morning. Then you've got Aaron Bright. Scotty Byrne, our heart goes out to you, sir. Scotty Byrne is not feeling well. He was meant to be in this morning and called off last minute yesterday. Cheers, Scotty. And then, yeah, we've got all sessions opening bell. So, of course, that's going to be quiet ahead of the CPI due out later on today. And then Art of Investing, episode 4. So episode 4 is all about commodities, Bitcoin, and gold. Some people include gold in commodities, but precious metal.
And beating insomnia. Thank you very much for that one, Rich.
Here we go. Hey, have you seen how many viewers the latest one's got? Whew, it's hot.
It's nothing I like more than sitting around listening to 3 white dudes talking about investing in bonds.
What would you rather?
Just you and me. Just you and me. Candlelit dinner.
Right, what have we got coming up on the economic calendar? So, that's it. The core inflation rate, 3%. We're going to go through that more in a minute. We've got UK GDP that has, it's expected out on Thursday, minus 0.1%. What else you got coming up this week, Ronnie?
Trying to get my computer sorted, but after that, where did you leave off? We have USA PPI, month on month. Estimate is 0.2. Looks like someone forgot the comma. We forgive and forget in this studio. Retail sales coming out of China. Year-on-year estimate is 5%, and the US retail sales estimate is 0.4.
A bit slow in it this morning.
Yeah, it seems like they haven't had the Red Bull this morning.
Right, let's go on to overnight action. Right, let's go straight into that CPI preview then, okay? So 1:30 this afternoon, we're going to get consumer price inflation. Expectation is a rise up to 2.8% for the headline rate. That's year on year. The core inflation expected to come in at 3%. Now, if those come in line, that's the highest numbers we've seen since February. Of course, slowing jobs. We saw a slowdown in the jobs as well as changes to the previous months. And then we get potentially higher inflation. Now, is that a mix that Jerome Powell is comfortable in to cut rates? We'll find out next week at Jackson Hole. Jackson Hole is the symposium when the central bank really sets out its plans for the coming few months and into the end of the year. What's the market got priced in, Ronnie? Well, that is 51 basis points of cuts currently. 51 basis points. That's 2 cuts. That's expected to come in September and then either October or December. What are we going to expect after today? Higher or lower, Ronnie, inflation?
Inflation? That's a tricky one. I do think we're gonna go for lower.
Lower than 2.8 at the headline, lower than 3 at the core. I'll take the other side of that.
I actually don't believe that, but I want to be a contrarian. But before we proceed, some of you may notice that I looked over here, and that's because I thought you were reading off a script. But so impressive, Rich.
Thank you very much.
Wow. You really have a talent for yapping. I salute you, good sir.
Yappy McDonald. What was your nickname at school?
They used to call me Ronald.
Oh, same. That was it. I had the same nickname.
Hey, it's almost like we're so connected, so brothers.
Right. What have we? What UK news have we got this morning?
Yeah, we saw some pretty interesting news coming out of Entain, who had very strong results. We also have, this one is, you know what, I'm going to give you this treat because you gave such a good monologue, you deserve it. SWC has bought another 295 Bitcoin.
That's a lot.
Hey, big spenders.
Is that so? We'll have to have a look at how much money they've got left, because that's they're not messing around, are they?
I think they spent around 23 million pounds on it.
Right.
But yeah, so in addition to that, we saw some pretty strong overnight, or last night we saw some pretty strong moves from the consumer staples in the FTSE, due to the belief and hope that we'll see some stability coming out of Russia with the upcoming peace talks. Personally, I'll believe it when I see it. Not sure about you.
Are we calling them peace talks?
What are we calling them? What are they calling them?
Well, Trump saves the world.
Oh, my
Trump's Nobel Peace Prize.
Who was it that nominated him? Was Israel and Pakistan, was it?
Good morning, Pelican. He says, good morning, Scottish man and team. You're just part of the team.
Oh, wow.
Andrew McKelvey saying Bellway is building higher profits this year. They say very good. We like that one. Good morning, Shilling. Good morning, Jugger. Guten Morgen. DJ Phil in the house with the China.
The
right
one
there.
China.
Oh, I thought we were getting a beautiful bill there. So, right, inflation. What is the poll that we have up then? Where do you expect China today? Is it going to be higher? Is it going to be lower than expectations, that is?
Yeah.
Or I would imagine he's probably got a only time will tell in there.
One would hope so, because time holds all the answers.
Right, I'm going higher because of the tariffs obviously coming into play, and then
Which have now been postponed an additional 90 days.
just the China ones.
Yeah,
But you got all the other ones.
exactly, yeah.
And yeah, I think I just get the feeling that you've had the sort of the drop that we'd seen before, and now it's about time that we, if the economy is that strong, then I would imagine there would be some kind of demand push on inflation higher.
Are we talking about the American economy now?
Absolutely.
Yeah, I mean, the American economy is just continuously showed excellent results. I think that's why no one can really blame Powell for not cutting rates soon enough. I mean, except for Trump, of course. It has shown excellent results. I think that now the last batch of economic data was the first time we saw some sort of cracks. So unless we see, I'd be surprised if we see some negative results.
Is it all capex though? What would the American economy be doing if there was no AI?
That's a good question.
Because to me, if you're throwing hundreds of billions up to $1 trillion of AI capex spend, that's driving a lot of jobs. It's driving a lot of factories.
But
I just wonder if
AI
that's...
capex isn't slowing down. Every single Mag 7 company announced even further capex in their earnings results.
Yeah.
So it's not slowing down.
Sorry, I'm more meaning you've got very much a two-tier economy.
Oh yeah, that's for sure. The consumer itself, I mean, when we looked at, so for example, when we looked at US consumer staples, last week on the earnings, a lot of the companies are struggling in terms of getting that sort of low-end consumer in. So there is a difference, as you say, between the coastal elite, as I like to call them, spending big on AI, and then the everyday American. So I don't think the everyday American is feeling like they're a strong consumer and that the Hank the Tank, that they're feeling like they're doing very well and have more spending power. So I think a lot of people would welcome a rate cut.
Yeah. Okay. So next week, Jackson Hole. What do you think? Do you think he comes out and he says, sorry, President Trump, you were right. We're going to start a rate cut cycle from September. Everything aligns now. And he's going to kiss the ring like Tim Apple did?
Tim Apple? I don't see my man J Powell bending over and kissing the ring. I do think that he's a man of strong principle, and I think he's shown that by not allowing himself to be bullied. I think the first time that he's actually shown now that he's, weighing up a rate cut was when he saw that the data supported it. Mm-hmm. He's very much a data-driven Fed chair, so I don't believe that he's gonna, come and say, Trump was right, I was wrong, he's the wisest man ever.
That's why it's so important today. This Powell must be hoping for lower inflation today, so at least all the pressure's gone.
Yeah.
He can come out. Let's have a look at what the Fed projections were in June, right? So this is in June. Core PCE, they see finishing the year at 3.1. Headline, they see finishing the year at 3. So today we're expecting a 2.8 and a 3. And that gives their end of year interest rates at 3.9. So, and we've still got room in unemployment there as well.
Yeah.
That's 4.5. At the moment, it's only 4.2.
And still better than the UK's 4.7.
Yeah. Well, we can go on to that because we have just had UK unemployment rate. Ronnie, take us through the figures.
Yeah, so UK unemployment rate remains static at 4.7% as per expectations. Average earnings came in at 4.6.
Do you get a bonus as a junior?
Yes, we do.
Excellent.
We get quarterly bonuses.
It's nice when, they've got the big loaf of bread and they just chuck some breadcrumbs out.
I will not comment. I like employment, so I will not comment.
But you've now graduated. You're from the graduate scheme.
I was never in the grad scheme. Big Cooper was in the grad scheme. I started off as a trainee.
Right.
Worked myself up from the bottom, from Swedish customer service to now sitting here with you, Rich.
And when do you come out of being a trainee?
Oh, good one. For all the kids out there, work hard and you see what magic things can happen. One day you can sit with Rich McDonald and he's wearing shorts at an office and you can talk about the market.
What we haven't spoken about is this is the last week that you are going to be in here. This is your last ever appearance in this studio. And why is that, people? What's happening? We're getting a new studio. Very, very exciting. Yes, the green walls are going. The lights are going. The cameras are going.
What? The walls are green? I thought they were trade live with IG, red and gray.
Can we... Oh, it looks it. Yeah, shall we turn it off for a second?
No,
Don't break the illusion. But yes, we are moving to a new studio. So we're going to have a couple of weeks of slightly different shows. You're going to be joining us from the desk. And you might even see into my very tidy living room.
Yeah, I wouldn't be surprised if producer Phil showed up in my bedroom as well. Hey, mate, do you mind if I just get some China? Can
you imagine a roaming camera? Yeah, you'll say, oh, I didn't know I was on today. Right, okay, so we've got that unemployment rate, 4.7%. The average hourly earnings came in line, but the HMRC payrolls change were a drop of 8,000. So 8,000 less people telling HMRC that they've got a job.
That's not positive.
And yeah, claimant count down 6. So
Don't get rich started on that one.
let's have a look at what was on the front page of the Times. We've got, of course, the NVIDIA AMD story from yesterday, but I do want to touch on this European car market story.
Sorry, before we move on to the European car market, I just want to say that doesn't this goes to show that it was never about national security banning the chips in China. It was never about national security. It was all about finding a deal where they would profit off this massive pie that you're talking about. You talked about as well, the AI capex. The US want a piece of the action. I mean, the mob boss in charge. You got to kick upstairs. That's what it's all about. And now they're even talking about, they start off with you can sell the H2 chips. But now they're even talking about potentially being allowed to sell the Blackwell chips, which are the most advanced.
No, they are super duper. So in the Trump press conference yesterday, he went, do you know what the Blackwell chips is? Do you know what it is? That's the super duper chip.
Did he actually say that?
Super duper advanced. And he says, China will not get that for 5 years. What I might allow Jensen to do is take it down a notch, take it down by 30 to 50%, and then we might let the Chinese have it.
Or he kicks up the kickback.
Kicks up the kickback. But he said, I don't care about myself. It's not about me. When I say I want more money from Jensen, I'm not talking about me, I'm talking about the country.
USA, baby.
And so Trump hard at it while JD Vance is popping into his
He's going crazy in the group chats right now.
No, he's not. He's on holiday. So he's in the Cotswolds and he went into Dalesford Organic Farm yesterday with all his Secret Service agents.
Organic farm.
Organic farm.
Utter woke nonsense.
Have you never been to Dalesford?
No, I have not.
Of course you haven't. It's in Chelsea. Right, so we got some stories about the autos there. And we've got the European car market faces collapse, warns the Mercedes boss. He says that
the Swedish Mercedes boss, I might add.
Oh, is he?
Yeah.
Ola Kalenius.
Yeah, man.
So he claims the industry faces a perfect storm of challenges. Now, he goes a little bit hard on this analogy because he says the outlook for car makers is worse than a perfect storm. Our industry is experiencing heavy rain, hail, storms, and snow all at the same time. Car manufacturing is a tough business in Europe, more so than ever. And then he changes the analogy a little bit and he comes to say, we need a reality check, otherwise we're heading at full speed against the wall.
I mean,
that's a bit more.
Yeah, a good car analogy. I have to say I'm inclined to agree with my fellow Swede. I think it just goes to show that, the European regulation and the European market has pushed the car industry to this. I'm not, debunking any of the, need for greener alternatives, that we need to switch to EVs, etc. But if you compare how Europe has done it compared to how China has done it, where it's endless stimulus and there's government backing in getting this off the ground, whilst in the Europe it's more punishment, it's more the stick rather than the carrot.
Yeah.
And then we see, the Chinese are outpacing us in technological development. They're producing better, cheaper cars. How did that happen? You have all this regulation, taxes, and restraints. Why aren't you guys performing at the same level?
Yeah. And why can China get their cars 40% cheaper than a Mercedes or a BMW? So just to touch back on the story there, his view does carry particular weight because he's also president of the European automobile manufacturer. Easy for me to say. He is also president of the European Automobile Manufacturers Association. So, this isn't just the CEO crying out, as suggested by Jugger. But, this is it doesn't exactly give you confidence for the share prices, does it?
It doesn't, but it also goes to show that this isn't a Mercedes isolated problem. When we see Volkswagen struggling, it's not a Volkswagen isolated problem. The industry as a whole is suffering, and it's coming from, it's. I would like to say that it's a self-inflicted problem that the European Union has caused on themselves. Brexit means Brexit.
Yeah, because you were never in, were you?
No, I was never in.
Like Sweden just...
No, Sweden is in the EU.
Oh, is it? Sorry.
Yeah.
That's my ignorance.
Yeah.
But you've got your own currency.
Yeah, we do have the Swedish krona. We have a pretty good situation, much like the UK has outside of the Eurozone, but still have our own independence in that sense.
So if I go to Stockholm to present the show in a couple of weeks' time, then I'm all good. I don't have to queue up. You're gonna fast track me through.
Yeah, I got you, big man.
Actually, I could film from the IG offices then.
Like I've tuned in from the IG offices.
Nice. Okay. We just had a good idea.
Yeah, and but to continue our point, I think there needs to be a shift from a regulatory shift for us to sort of work towards and benefit the auto manufacturing industry, because that is the core of the sort of the European rustic belt. We see the production in Germany, which has been the strongest economy in Europe and has carried the economy.
Yeah.
But now it's lacking due to the fact that we're regulating too much. We're not putting out enough incentives on. So yes, I do agree with Ola Kalenius. I do believe that there needs to be a shift from the industry as a whole in order for us to compete with the Chinese, because otherwise in 20 years time, the Chinese, the BYD and the other Chinese cars are going to be the status symbols, and the German automobiles are going to be relics and collectives. I heard an interesting argument from Sean Rain, who is the CEO of the China Market Research Group. He was saying that there's been a fundamental shift in the Chinese consumer mindset, right? They're not going for Louis Vuitton, Burberry, Mercedes, BMW anymore. They're going for cheap premium. So they're not spending all their money on one item. They're going more for the Labubus and, Pop Mart as a whole, but cheap premium goods. So you can still show that you've got a nice belt, maybe even an Hermes belt. Do you ever have one of those? No.
No, neither did I.
But we'll have to ask Ange for that.
Yeah, so that sort of £100 to £200 price point, not the 4,000 to 6,000 anymore. And if that's a fundamental shift, then you do have to look at your ideas of what is luxury now and what's going to be successful luxury in the future. Yeah,
and also it tends to for me, I think we see like a shift from the Chinese consumer from international to domestic. I mean, a Volkswagen used to be a status symbol in China. Now a BYD is, or a Xiaomi is, and so there's a fundamental shift in the consumer. So I think this breeds, and this consumer shift in the Chinese consumer it's beating trouble for not only the automakers but also the European luxury companies as well.
So on that, this is a stock that this guy, the Chinese research was pushing. It is Pop Mart. This, of course, is, as we've mentioned once before, the manufacturer of Labubus.
What is Labubus? Everyone talks about what is a Labubu.
Right, we'll find Ronnie at a Labubu after we come back from the break. But it's not just a one-trick pony, right? You'd say Crocs. Crocs has only got that shoe, really. Whereas Labubu now has just opened their largest store in the world in Thailand, and the Thais are going crazy over it. So, it's an interesting stock. It's up 200% year to date. This is one that we missed massively.
Can someone in the comments let me know what a Labubu is?
We'll come to it after the break. You're going to be, your Christmas presents are sorted. But does it have anything more behind it? It's going to be interesting. Time for Guess the Chart, 7:55 and 30 seconds. What do you think it's going to be, Ronaldo?
Oh, I think he's gonna go a bit cheeky and he's gonna go English.
An Asian stock. This is our... Oh, no, we've already had Nissan, haven't we? We had Honda. So, yeah, people didn't like it. So this... What other stocks in Asia does producer Phil know?
Well, he loves PlayStation.
Nintendo. Right. Let's see what it is.
Woke up this morning, market's on my mind. I guess the chart's starting one of a kind. Footsie's moving, candles climb and fall. Axel's trade of the week is the talk of it all. Rich is trading, clicks all through the day. Angel's watching, she's got something to say. Shell and BT, Tesco in the frame. Name that chart, that's the game. We're on Trade Live with IG, guessing away. Please remember, folks, not financial advice today. While this song plays, they're working it out. Charts on screen, what's it all about? Cam's on the camera, Terrence calls the cue. Dom's in the booth, keeping sound on you. Dr. Watson's watching, Johnny's rolls the feed. Ainge drops the facts, just the thing you need. Rich is quick to jump on a swing. Ainge digs deep, asking the real thing. Producer Phil says it's your call. And guess the chart, we want it all. We're on Trade Live with IG, guessing away. Please remember, folks, not financial advice today.
All right, trader friends, welcome back to Trade Live with IG. You're joined by me, Ronaldo, and other Ronaldo, the Scottish Ronaldo.
Ronaldo McDonaldo.
Ronaldo McDonaldo. We've been looking at the chart. Our brains have been working. And my
Hamish.
Scottish brother, Hamish, once again, correct. Alibaba.
He's on fire.
Yeah. Not my Baba, Ali's Baba.
So Alibaba onto Labubu. Here we go, introducing this scary thing to the world. This is what has sent that stock up 200%.
What is that?
You buy it in this little box here, and it's what all the kids are going crazy for. So you're not exactly in the target age group, but your girlfriend might be.
My girlfriend is a woman of class and elegance. She wouldn't.
You buy her a Labubu and let's see what her reaction is.
She is way more sophisticated than that.
Right, so what we got coming up, it is 7:59 and 40 seconds. Get your bell in your hand, sir. The pre-market expectations are, let's get them up. What are we looking at? God, my eyesight's going. Opening calls, Bellway looking up 2%, Entain looking up 2%. Michael Page Group down 1.
Tell me when to stop, Rich.
Oh, keep it going.
Brought to you by
Hey.
LSEG.
Carry on. I had a conversation with a very intelligent friend of mine, ex-hedge fund, that is buying into Michael Page and buying into
Your ex-hedge
the recruiters.
recruiters.
Yeah,
Well, Hayes.
very unloved.
Yeah.
Hayes and Michael Page. Not recruiters for the ones that are obviously not going to be in an AI world, but more the highly skilled ones.
What's his rationale? Because I'm.
Well, let's go through it in a minute. Once we have looked at why are BHP and Anglo American top of the tree today, because iron ore is up 1.5% to almost to 800. Almost to 800. So BHP and Anglo American really jumping up there. I'd expect Rios to be there as well.
And Tane, look at that. Strong results.
So the two stocks with numbers are the winners.
Yeah, Entain and Bellway. I'd be more than happy to get the Entain figures up for the people at home.
And then we've got Burberry up 1. WPP 370. Has it found the base, Ronnie?
No.
Has it not?
Nope.
What's the target price on you for you again?
0.
WH Smith up 60 basis points. IHG post numbers last week.
Yeah, no wonder WH Smith is up. It's a robbery. I sent Rich a pic. I was up in Edinburgh. And I wanted to bring back some good old Iron Brew
Yeah.
and some Walker's shortbread for my lovely girlfriend to share the culture with her.
You told me it was for me.
Oh, forget about it. 9 quid they charged me. 9 quid for a small pack of shortbread and a regular Iron Brew.
In Scotland as well.
In Scotland as well.
My goodness me, you got done there.
Yeah, I did, and I was too ashamed to put it back after I saw the price.
Why? That's to be the first thing I would do. Right, and I would go and tell the person who worked there as well.
I want to talk to whoever is in charge of dynamic pricing, because they know I'm a sucker for an Iron Brew and shortbread.
They're very smart. Right, Ocado down 50 basis points, Canal Plus, £2.44. Where were we buying this last year? I've had a mind blank there. Is this?
I think we were buying it sub 200.
Oh, yeah, it was like £1.70, wasn't it?
Yeah.
Oh my goodness, yeah, this got down to £1.60. So this is up 50% from the lows. Interesting, right? So Canal Plus was, and then what about Havas? Has Havas done the same? Havas was another one that my intelligent friend, not amazing. 130, say, was the realistic price.
For the people at home, I obviously well familiar with Havas, but for the people at home, do you want to tell us what Havas does?
So Havas were part of Vivendi.
Oh yeah.
And we're the publishing arm. And that's very adult of you to admit that you didn't know.
No, I knew it was just
in the FT today, the Financial Times has a great article, The Lost Art of Admitting What You Don't Know. So Sarah O'Connor would commend you for just admitting you didn't know what Havas was. It needs more. More people need to say, I don't know.
What can I say? I'm a humble guy.
So that's my challenge in the next 20 minutes.
But what I do know is the results of Entain, which are pushing them up.
Go on.
So Entain reported adjusted EBITDA for the first half year to beat the average analyst estimate. Adjusted EBITDA was 583.4 million, where the estimate was 542. Adjusted pre-tax profit was 226, where the estimate was 225. Net gaming revenue is 2.63 billion, whereas the average, where the estimate was 2.67. So net gaming revenue is up 3%, and revenue is up to 2.6 billion, and interim dividend per share is 980p.
Nice.
Thank you very much, sir. Bellway.
Yep.
Full year homes completed, 8,749 versus estimate, or versus year on year of 7,654. So they've done almost more than 2,000 more homes than last year. And they see adjusted operating margin at 11%, where the estimate was 10.9.
Good.
Bellway, are you bullish on the home builders?
This is such a... Do you know, I traded them back in 2006, but I've never really got my hand around the business model, because it's, you know, I was always mining steel, but UK home builders have got such an extra element to them, and it's really tricky.
Yeah, it's a very cyclical business. My concern is how, you know, I mean, obviously I'm wrong, because I'm not very positive on home builders, but they seem to keep developing, and they seem to keep building out new areas and finding new plots of land to build on, despite the regulatory red tape. So yeah, I salute them for doing.
I think it's quite a specialist sector. I think retail, you can have a crack at retail because, you know, if your girlfriend wants a Labubu, she wants a Labubu, right? Yeah. But just because you want to buy a house doesn't mean you get into home builders.
Exactly.
So I think it's very specialist, and I don't know.
I salute you too, Rich.
Right, let's have a look at what's going on in Europa. How are those car builders getting on this fine morning? This morning that it's going to be 32 degrees, so get your shorts on if you're going into the office today. Stellantis up 1.3, Kering much the same. Schneider, Puma's an interesting one. I passed that on Carnaby Street last week. I think it's such a dead brand.
Yeah, I mean,
unless you're a Man City supporter.
Then you're even more. That tells you everything you need to know about them then. Yeah, Puma in general, I don't know. When was the last time you saw someone wear something Puma?
Well, just this Man City deal. That's all their shop is now, is Man City shirts in the middle of Carnaby Street. I guess the tourists like them.
Yeah, I mean, but on the other hand, if you look at a true fashion house, which are continuously impressing me, is Hermès International.
Really?
Yeah, I mean, look at the stock. The company is doing so brilliantly. When every other luxury manufacturer is struggling, they continue to be the crème de la crème. Not if you look at the chart like that. Zoom out a bit. Zoom out a bit.
Producer Phil, can you turn that upside down, please?
Zoom out a bit. Zoom out a bit. You guys are short-sighted. Zoom out. Ah, look at that, yeah, beauty. It's like a Steven Gerrard cross.
Steven Gerrard cross. What's he doing now? Is he a manager?
I think he's a manager in... I think he got the sack from Saudi Arabia even, or he quit.
Right. Well, talking about getting the sack as a football manager, yes, we are only days away from the start of the Trade Live with IG fantasy football Premier competition. It's going to be announced on Thursday and Friday. You'll get your code to join the league. But Angeline is talking about sorting out a prize for the year.
You know, I might even join. Last year was the first year I didn't join because I'm very excited when I start off at the beginning of the season. I spend a lot of time crafting my team, and then we get to game week 12 and I've forgotten completely about it, and I go into my team and I realize I have 2 injuries and 1 red card in my starting 11, and then the game's gone. But this year, just because I want to beat David Boise.
Yes, we got to beat Boise.
Me against Boise.
Right, in a couple of minutes' time, we are going to be going over a couple of questions that Boise did put to me yesterday, and very wise that we do that. And we'll talk about if somebody wanted to short for the first time, how do they go about it? If you just got a stocks and shares account, how can you go about shorting? So we're going to go that after the break, seeing as we've got the guy who's just been through his training scheme, then you've got all the answers.
Not me.
So do you know who you remind me of? I've been watching, if anybody has the TikTok, go onto the Argos and the Curry's pages. They're having a ding-dong battle against each other where somebody from Currys is going into an Argos store and somebody from Argos is doing a video in a Currys store, and they're going for each other, just saying that, you know, how bad the service is and how, you know, their shop's much better. It's so funny. But the best bit is, on the comments section underneath, all the other UK retailers and brands are commenting. And so it's a real battle of the brands. You'll be hearing about this in the next couple of weeks.
Very much look forward to that.
Because it's escalating.
I can't wait.
Right, give
Edge
us...
of my seat.
Do you want a like or a subscribe? Which one?
I want both. Like and subscribe.
Have both.
Producer Phil is screaming in my ear. Like and subscribe, please. He's got 6 children at home he needs to feed. Every like is 1 meal for Producer Phil's children. Every subscribe means warm socks on their feet. So please like and subscribe for the future children of England. Thank you very much.
And Scotland.
And Scotland, of course, because they've been neglected enough. Margaret Thatcher, we haven't forgotten about you.
God bless her soul. That's it. So if you haven't liked and subscribed now, then good. Trem pointing out, Puma also do Borussia Dortmund.
They're actually a shareholder. I think they're a shareholder in Borussia Dortmund as well.
Right. Okay, let's have a look at the Puma fashion gear after the break as well. And then Formularizer. Catchy. Guessing Walt Disney Company. No, it was Alibaba. Alibaba.
We do love, sorry, Steve Davis, the Children of Wales as well. All of UK and Ireland.
Steve, we apologise.
All of UK and Ireland.
One of our dream team through there, Dom, was actually in Wales at the weekend, and he was showing us pictures of is it the River Wye, Dom? River Wye, and he just said it was spectacular, like a different world.
Yeah, I mean...
beautiful Wales.
Yeah.
My first ever girlfriend from Pontypool.
Oh, exotic.
Right, 8:12 a.m. We'll see you in 2 minutes when Ronnie's going to be going through how to short, Palantir, how to short for the first time if you're going to short.
Okay guys, before I teach you how to use this, I have to teach you how to use this, the mind. The cash return wasn't all about speed, it wasn't always about power, it was about the mind. Become the bull. Visualize greatness. Okay, minds are ready. Time to go. Hey, come on, Pat. Cash returns, come on. Oi! Oh, you're not going to get better than cash returns.
Today we're here because we've recently launched our Save Our Stock Market campaign. We just want to raise awareness for terrible cash returns that everyone is getting with their money just sat in cash ISAs. What we want to do is raise awareness for the great returns that you can get on UK stocks and help revive the UK stock market and get people investing.
There's a lot of bad feeling about the UK stock market, and it's really negating people's view on the UK market as a whole. There's some great companies. If we just start the ball rolling on people getting behind the UK stock market, then we can start to get the interest. And it's days like this, we get awareness of all the crowds talking about stocks. It's really that awareness, and ideally we'd like to take it to the government. We would like cash ISAs to be reduced, not because we don't believe in the chance of people saving, but more that you get higher returns, as much as 7 times historically in investing that you can from cash. And that's not saying people go out and take a load of risk. It's about education, and it's about helping people to understand the benefits of investing and the limitations of holding their money in cash.
We're watching a crisis unfold in the UK, and we need to take bold action. Our stock market, once the envy of the world, is in a dangerous downward spiral. At the same time, the UK is stuck in a damaging savings-first mindset with far too few people investing to build wealth for the long term. With our Save Our Stock Market campaign, we're calling on the government to deliver the urgent policy changes our stock market badly needs, from scrapping stamp duty on UK shares to encouraging a shift away from stagnant cash savings and using incentives rather than penalties to get people backing British firms. And to show we're putting our money where our mouth is, we'll be offering every new customer who joins IG across July and August a free UK share bundle. For too long, policymakers have been paralysed by the desire to keep everyone happy. But the time for working groups is over. This is about getting more Brits investing while saving a strategic national asset before it's too late. You can read more about IG's SOS campaign and free UK share offer on our website.
Hello and welcome back to Trade Live with IG, the morning trading show where we're not afraid to say that we don't know. I am joined by Mr. I don't know anything at all, Rich McDonald.
I liked Boise put on there, all I know is that I know nothing.
Shout out to Socrates.
Yes, nice.
Come on.
Very well done. Now, what do we know and what does Ronnie know? We're going to test Ronnie's knowledge on signing up. So the question was put to, well, two questions were put to me yesterday. If I've got a stocks and shares account,
Yes.
and I want to short something, I obviously can't do it in the stocks and shares account or my ISA or my SIP. How should I proceed into spread betting, CFD, and what's to be aware of?
Yeah. It is very simple to open up an additional account if you already have a stocks and shares ISA. If you have any sort of account with IG, when you log into my IG and you see sort of, hello David, welcome back, you'll see a blue button that says add an account. There you get the option to select if you want to add either a spread bet or a CFD account. There are benefits, pros and cons to each type of account. So we obviously have the Brilliant Crypto. So spread betting, tax-free, regulated as a gambling product, so you are not paying any capital gains tax.
That's this one. So the advantage of that one is, in most circumstances...
Yes, obviously we don't give tax advice. Please consult your local tax advisor. But it is, I've heard, tax-free.
Yeah.
Don't quote me. Then we also have CFD trading. So
this is the one that I use. So if you're looking at my platform, you'll recognize it from this.
Exactly. So CFD trading, you get to see stocks exactly like they are. Spread betting, it is you're betting pounds per point or dollars per point, amounts per point, versus buying amounts of shares in CFD trading. CFD trading is not exempt of capital gains tax, so that's worth taking into consideration.
Because I like supporting the nurses and the policemen of this.
Exactly, because you're a good citizen, UK citizen. I am proud to be a fellow Scotsman because of you. So you can trade CFD trading. The difference in your experience won't vary much. So those two are the options, the ways you can go ahead in trading or short trading stocks or other commodities or any other assets.
And so let's say, for example, I wanted to short $1,000 of, or $1,800 of Palantir. So there's two different ways to go about it, isn't there? Because CFD, I would choose number of shares.
Yes.
Which would be 10 shares.
Yeah.
How would I do it on the spread betting?
So on spread bet, one way to look about it is that £1 a point equals 100 shares. Now, obviously, there's a currency conversion here, but Rich, if you do us the favor and pull up the Palantir chart, so if you are interested in going against one of the hottest stocks out there with who stand to benefit a lot from the AI development, and jump on the rich fan train, what you would do is you would go on.
Is this the same one that was down 2% yesterday? Yeah.
Yeah, and it's also the same one that was up 12% last week.
Right, so I've got a Palantir.
Chart up, guys, chart up. And if rich, press sell.
Sell.
Yes, choose your direction. And then you type in 1, for example.
Oof, that's a lot.
Then you see a lot. But as you see on the side of it, per point minimum is 0.1.
0.01.
0.01. So you can go even shorter than that. But the nifty feature here is that if I'm interested and I'm thinking, how much am I actually betting? How much am I actually investing in this? How much am I actually risking by following rich? Then you can see the notional value just under there.
Yeah.
Obviously, this is not trading advice. This is simply guidance on how you can
use the system.
realize your investment ideas. Yes, so you can see the notional value. So this gives you the actual level that how much you're actually trading. And if Rich types in a price level.
Price level, so let's go 200, because that's where everybody thinks it's going. So actually do 19999. That's a, but that's an.
Is that
yeah, that's
is
an
that
order.
your entry level?
That is where.
Yeah, I'd short it from that too, mate. But if we put in a realistic price that you would actually enter at.
I know, but that is where the viewers yesterday thought it was going.
Okay, great. Perfect. Thank you very much, Rich. And if you look at the bottom, you see margin. And so that shows you how much you're actually putting up in margin to open the position. And you can compare the 179 versus the 1,828. The difference between those two values, that's the leverage that you're using. So you're actually only putting up a fraction of the amount to trade. This comes obviously with inherent risk. It's a double-edged sword, because if the stock goes up 1%, your profits are amplified and multiplied. But if it goes down 1%, it's the same way around.
So that's about a 10-for-1 leverage.
10-for-1 leverage. So if the stock goes up 1%, you will actually gain 10%, because you're only paying for 1%, but you have exposure of the full amount. However, if you lose, the losses are multiplied as well. So that's why it's important. Risk management and risk tools are much more important when you're trading on leverage with spread bets and CFDs, especially when you're going short, because in theory, the potential losses are infinite. However, as a retail trader,
The market always goes up.
exactly. However, as a retail trader, you are obviously protected with the non-negative balance protection, meaning that you can't lose more money than you've deposited into the account.
Yeah. So be very careful with the size that you're putting on relative to the capital you've got in your account, right? That's the real important thing. I always make sure I leave a nice bit of headroom.
Yes.
So even if Palantir goes up another 20%, I won't get stopped out.
Which you will. But yes, so hopefully the insight that you've gained here is how you can go short, how you can manage your risk. Any questions from you, Rich?
Yes, my next question would be that in the Financial Times today, in the Times, I saw an article on how to pick a stocks and shares ISA. So forget all this shorting rubbish. You want to invest for the long term.
Yes.
Now, what, at the moment, let's say my sister, for example, she wants to phone up Mini Cooper and she wants to open up a IG stocks and shares ISA. Take me through the benefits and also the costs of dealing, because she's only got about £500 to put in it.
Brilliant. Absolutely. Despite the betrayal of selecting Mini Cooper over me, you know what? I'm gonna address Mama McDonald here instead, because this is
Mama McDonald's got an ISA, don't you worry about that.
Okay, Sister McDonald, all is forgiven. Water on the bridge, one love. Yes, so if you want to open up an ISA, you can go ahead and do that same process as we showed earlier. You add an account.
Okay.
If you don't already have an account, otherwise it's very simple directly from the first page. But selecting a stocks and shares ISA, it will give you the opportunity to invest in over 11,000 stocks and 11,000 stocks that are accessible through the platform.
Not just ETFs like some other platforms are.
No. You get stocks and ETFs. And the benefit of doing so is with IG is 1, you get commission-free trading.
No commission.
No commission. You heard that right. You heard it here, people.
What?
0.
My ISA providers charge me about £12 a trade.
Well, that's why you should come across to IG, the best ISA provider in the business. And we are saving our stock market. If you sign up for a share dealing investment account, you get a UK stock bundle worth £100.
Really?
We put our money where our
Vodafone?
mouth is. I can't tell. I guess you gotta sign up to find out.
But I tell you what, that runs out soon, doesn't it? That only has 2 days left on it, that offer.
Get them while they're hot. Get them while they're hot.
So, right, take me through. So to buy a UK stock,
Yes.
there's no commission.
There's no commission, and obviously because you deposit funds in Great British pounds, you will not be charged, and you buy a British stock, there won't be any conversion FX fee. So you'll be able to buy a stock completely commission-free without any sort of fees at all.
Okay.
In relation to that. And the best part is, if you ask me, you've selected your stocks. You said anything but Vodafone. I want to invest in something strong and powerful. I'm investing in Ocado, futures company. I have put in £500. I invest £400 in Ocado. I have £100 left. Is that money just sitting there collecting dust under my mattress?
Yeah, you're not going to pay me an interest on that, are you?
We are. We are paying
What?
4%. The Bank of England base rate is paid on your uninvested funds.
Impressive.
Save our stock market, baby. And we're doing it by offering the best offering here for the UK.
If you have cash in the ISA, is interest paid and what rate?
4%, the Bank of England base rate, and it's paid on all uninvested cash up to £100,000.
Great.
Cash returns. Come on.
Now, just one note, of course, if you're buying an American stock, you've got to pay for that American stock in dollars.
Yes.
So there is an FX fee.
There is an FX fee of 0.7% that is applicable.
And then is there a stamp duty in the UK?
Stamp duty,
single stocks.
stamp duty is applicable for LSE stocks.
But if I buy an ETF, that's always the one I don't
You know what, Rich? I don't know.
That's what I was looking for. Yes, boom. I don't know if there is stamp duty on ETFs either. Shall we have a look at our good friend ChatGPT or phone a friend? What one shall we do?
I'm gonna phone my friend Perplexity.
Yes, Phil, you are our friend. Is there stamp duty on UK ETFs when investing in an ISA? Because, of course, there's no difference between providers for that. ETFs held within a UK stocks and shares ISA are not subject to stamp duty,
There you go.
whether they're UK domiciled or overseas domiciled. That's really interesting, isn't it?
You know what I think, Rich? I think IG has put their money where their mouth is, and we're offering a free UK share stocks bundle for new clients to sign up and open up an IG investment account. I think the UK government should put their money where their mouth is. No stamp duty on LSE.
On an AIM stock.
AIM stocks, there's no AIM stocks are exempt. I think
And Aquis.
and Aquis. I think the UK government should put their money where their mouth is and remove all stamp duty on all UK stocks.
It's true, isn't it? Because now that makes me think, oh, I'd rather buy an ETF rather than a UK single stock. If we want to save our stock market, that should be, at least for small accounts, at least for...
Maybe not for institutional investors, but absolutely for individual retail investors. For the good old Mom Pop and David Boise, you definitely should not pay stamp duty.
Right, it is 8:30 a.m. on this Tuesday, the 12th of August. If you enjoyed that, people, give Ronnie a subscribe. Not in his TikTok.
I'll like and subscribe for the children of the United Kingdom and Ireland.
Shall we see how many likes you managed to get today?
Ooh, dire.
20. Only 20. Is that all we're worth?
Personally,
Painful.
my self-worth is attached to the number of likes I get, so that's really harmful.
That's what social media is all about, isn't it?
Exactly.
Right, Ronnie, what are you doing for the rest of the day? Anything interesting?
Yeah, I'm gonna continue to maximize shareholder value and generate client value on the phones. Bring, IG Ronnie speaking.
Are you not going to champion the client?
I always champion the client. That goes without saying.
Good stuff. And are you going to end up as champion of our fantasy football league? That remains to be seen. I've got a cracking team. I've already done my first week. I've already then changed it because I don't know much about what teams got promoted. Leeds, Sunderland.
Anyway,
I got to do my research.
Thank you so much for coming on, guys. It's been a pleasure.
Right, long SWC, short Palantir, ready to go.
That is not trading advice. That is not advice.
Okay, have a wonderful day, people. I am jumping now. It's Angeline and Aaron. Right,
Aaron.
Coming up next, he's going to tell you more about the secrets behind the man versus machine. I know that is a big fan favorite.
Oh, yes.
The new segment, Man versus Machine. Yeah, Aaron's going to let you into the behind the scenes there when he's on here in a couple of minutes. Enjoy your day. 32 degrees. Get that factor 70 on. In the last video, we talked about how the S&P 500 has a higher PE ratio than the FTSE 100 because investors expect faster earnings growth. But let's look at what happens when those earnings actually grow and why that makes such a big difference. Here's the S&P 500 in year one. Its PE ratio is 24 times, which means investors are paying 24 times the earnings to buy shares. This tower represents the share price. The height of each block reflects the unit of earnings needed to support that valuation. Now, let's jump forward to year two. The share price hasn't changed. This tower is exactly the same height, but look what's happened to the earnings. Each of these larger blocks represents higher earnings compared with the smaller ones from year one. Because the earnings have grown 50%, what used to be 24 times earnings in year one is now only 16 times earnings in year two. That's a huge improvement in valuation, even though the share prices have stayed the same. This is the power of earnings growth. When companies deliver stronger earnings, the PE ratio naturally comes down, making the stock look cheaper, even if the share price hasn't changed. And when investors see that kind of growth, they're more likely to stay invested or even buy more shares. And that's what pushes the PE ratio back up. And that's what makes shares go up or down. Now compare that to the FTSE 100 where earnings grow more slowly. Even if the share price stays the same, the PE ratio doesn't improve as dramatically because the earnings aren't growing as fast. That's why growth is such a critical factor in investing. It's what drives long-term value. So here's the big lesson. Earnings growth doesn't just boost a company's value. It makes the stock more attractive by improving its valuation over time. As an investor, the holy grail is to find companies that can grow their earnings by more and for longer than other investors may already expect. This may even mean avoiding shares that are already very popular, overowned, and potentially overvalued. Because if a stock on a very high PE ratio misses its earnings estimates, then the price can come crashing down.
Hey, trader friends, welcome back. It is Aaron in the house, and we were outside watching intently. Welcome to the show.
Thank you. It's been a while since we've been on together.
Yeah, it has been a while. I've missed you.
Likewise.
But Aaron's been so busy, and also when he's not busy, he's doing these amazing adventures. The latest one is in Scotland coming up.
Yes, on Thursday, going to Edinburgh Fringe with a couple of friends. So, yeah, excited. So if anyone's got any suggestions on what to see in the comments, or what not to see, I think more importantly, please let me know. So
I've never been.
I've never even been to Scotland, so I'm sure Rich is probably, very stressed outside at that fact. But yeah, never been to Scotland, so first for everything, I guess.
How can you never been to Scotland? I mean, we've got the bagpipes on for you. Thanks, guys.
I know. It's terrible.
You have to tell me about the Fringe Festival, because I have not been. Heard great things.
Likewise, that's why we're giving it a look this year.
I've been trying out lots of amazing restaurants.
Oh, yeah?
Yeah. One of them actually owned and run by one of our trader friends, one of our
Really?
clients that watches the show. Call out to Tiffany. And the latest restaurant by Tiffany and gang is the Shan Sui restaurant. They've opened a new one called Shan Sui Social. And it is located quite close to Victoria. So I highly recommend it. I mean, the food is incredible.
That looks good. That looks like some of the food. That looks like some of the food I had in Hong Kong a while back. So.
Tiffany, producer Phil's asking you if there's a discount for us trader friends. So loads of people on the chat this morning. Good morning, Boise. Away for a numbers meal. Good morning to you as well. Although, are you in the UK or are you traveling at the moment? Julian, I have the answer for you. Julian asking if you have cash in the ISA. Is interest paid and at what rate?
Yeah.
Oh, great, you've answered it already. Yeah. Fantastic. 4%. Unless Bailey starts cutting.
Well, we are expected to have a few more rate cuts this year, so we shall see.
Is it still 2 before end of the year?
I believe that's the forecast. That's what the markets are saying. But I think it's really going to be quite data dependent. Has been for the past few years, and particularly with the Bank of England, and the UK CPI figures, if you pull them apart, firstly, you've got a CPI rate which is higher than continental Europe and the US, which has seen a much more successful fight against inflation, I would say. Even though we've brought it down by a long shot, we're still at that sort of 3.5%, 4%. But if you go under the bonnet and you look at what's driving the inflation, it's services, which is, if you look at the other components there, it's sort of a bell curve shape where it's up and then it's come down. But the services inflation has almost been around that 4.5%, 5%. That's been the annoying thing in the UK, and yes, that could be tricky to tame. And if that lingers, then it brings into question how quickly and what magnitude rates can come down by.
Yeah. Also, just whacking up the cable for you, because we did see on Thursday, and both Seb, our newest addition to Trade Live with IG, our new video editor, and I were at the Bank of England. I was right in front of the bank, along with Faisal, Islam, and all the great and the good of the media. We got the news out to you guys first, because I reported on the bounce in the pound, because it was such a narrow vote.
Yeah, you even had
you
had a vote for 50 bips as well. I mean, it was interesting to see the 5-4 split, which I think really shows how divided people are.
Yeah.
I mean, it's not uncommon to have split decisions, but to have such magnitude of opinions and such a diversity of opinions is the more weird scenario, I would say, in that situation. Right.
And for the first time ever, trader friends, if you missed this, for the first time ever in its history, the Bank of England, the MPC members had a revote. So that just, I would have loved to be a fly on the wall.
Yeah.
Because, you know, MPC members, anyone with the central bank, known to be very sedate, very calm, but that would have been an exciting meeting. Which camp are you on? Some thinking that perhaps because it was such a narrow vote, we will see the pound very much well supported going ahead. But then again, we've got the Fed as well, and the dollar. Obviously, all this is linked to the dollar. Dollar weakness is expected because of Trump, and you know he's not been keeping any secret that he wants JP to go. So then we could see, you know, the dollar perhaps fall further.
Definitely.
Yeah.
I mean, they've held for the time being, but look, I think it's the worst kept secret that many are predicting two rate cuts in the US. And I'd say that the data there is definitely more inviting for rates to be cut compared to the UK. But it's very much going to be continue to be data dependent. And I think, you know, when you look at employment data coming out of the US, that's obviously taken a bit of a turn for the worse, and job openings have also taken a bit of a turn. So that could propel the Fed to sort of look at other areas where they can cut rates and say, well, you know, inflation's come down, but we also need to prop up the economy if things get really bad.
Andrew McKilvey on the chat. I thought about you, Andrew, when I was away and Sarabi Gold started moving higher, finally. Andrew is asking, Ron, wage growth still too high in the UK for 2 cuts in his view for this year? What do you think?
It's a very good point by Andrew there. I definitely agree that wage growth is too high. But one thing which is catching my mind and will be catching the Bank of England's attention is the fact that the unemployment rate is going up and job openings are going down. So it's this sort of dual situation where you've got the economy, which is certainly on its, beginning to go to its knees in the UK. I mean, we had a bit of a contraction in May, and it's just plodding along, I'd say. The government hasn't done too much to promote economic growth, as we've discussed quite a few times, in terms of NI hikes and other sort of contractionary policy to boost what they call the fiscal black hole. So that's why we might see the rate cuts, is if inflation does come under control, but we see the economy sort of continue to splutter along, that's when we might see the cuts. But it's a balancing act for the Bank of England, for sure. And it's also important to note that they do come with a large degree of lags, central bank policy.
Yeah, tends to be rear view mirror.
Definitely.
A lot of the time. Speaking of which, have you seen the Bitcoin adverts recently that have been banned?
A Coinbase, is this?
Sorry, Coinbase.
Yes,
Coinbase.
I have. You know, it's funny. My sister showed it to me about 2 hours ago. That's the first time I've seen it, but it's quite amusing.
Trader friends would like to know if you've seen those videos by Coinbase. What do you think of them? Well,
it's entertaining to say the least. I mean, that's kind of what people are thinking about the UK economy at the moment. There's certainly issues which need to be addressed, I'd say, in terms of growth, productivity and inflation, for sure.
They seem to be using the same sort of vibe, if you like, I felt, that helped a certain person gain a second bite at the presidency.
Yes, exactly.
Speaking of which, loads that are tradable events out the US. So we've got loads coming out. We've got, of course, the CPI data that's due as well. Lots of inflation concerns there, and we had a poll earlier today. Have we got the results of the poll already? Fantastic. So if you could just show it to our trader friends. Ronnie was saying he thinks it might be cooler. Rich and I think it might be hotter. I think it's certainly going to be hotter because we've
got tariffs coming into bite.
Exactly.
And what we saw before the tariffs came to fruition, May, April, that sort of time, we saw tremendous amount of front loading, which makes sense because if you're a business and you've got a load of goods to buy, you're going to front load on them, buy tons of them before the tariffs kick in. Now you don't really have that opportunity because a lot of the tariffs have come into force. with the exception of China, they've got another reprieve. But
90 days, yeah.
exactly. But we're looking at an effective tariff rate of between 15 and 22% when push comes to shove and everything comes to plan, which is high, and that will definitely seep into those inflationary figures, and it will definitely affect the consumer if costs are passed on.
Yeah, 64% of our trader friends think it will be hotter than expected.
I'm on that camp as well, just like you, I think. I don't think, potentially we're not going to get huge figures, but hotter than expectations, even by, 10 basis points, something like that. Yeah, I could see that happening.
What's also interesting, is the fact that it comes in a time when, the markets aren't kind of reacting the way you think they will, right?
Yeah.
On the one hand, we've had, all these tariffs. We've had that tariff tantrum in April. But guess what? People came back in and bought again.
We're at all-time highs.
Yeah, all-time highs. S&P, near record highs, 6,384. Despite all this volatility, all this talk of tariffs, market remaining in a strong uptrend still.
I'm going to cast my mind back to 2018 when we saw a huge, well, not huge, but we saw quite a nasty tantrum in the stock market in Q4. And it was all tariff related, and it gave up, the US equity markets and equity markets in general gave up a huge amount of their gains for that year. So something to keep in mind as we muddle through this trade war with the China situation yet to be resolved. And we know how vital they are to global trade, particularly with America and other regions. So that's why I've definitely, walking with cautiousness in this environment, particularly with the valuations in the US.
So what would your view be if someone, for example, was, thinking, should I take it all off? Should I take half off? Should I redistribute?
Yeah, I mean, for investors who are investing for the long term, I mean, this is how we construct our smart portfolios, is we have a long-term strategic asset allocation where we plan to have an asset allocation which should last, for your investment lifetime, depending on your risk appetite. But we do make tactical tweaks, which last, between 6 months to 18 months, I'd say. And one area we've been very active on that is looking at regions such as Europe and the UK, which have relatively, the valuations are better compared to the US. And we think there's marginally less risk in terms of the valuation point that you're going in at. Because even though US equities have had 2 years of 20% growth, and this year, even after the immense volatility we've had, we're still up around 9 to 10% with the S&P 500, which is still, that's like the 120, 110 year compound annual growth rate. That's the annualized return. So that's still pretty good return, even though we're used to this 20%. So, I think what we're trying to do is understand that risks are present and maintain diversification across our suite of portfolios.
Nice. I'm going to try and do that, because right now I'm looking at my own pension portfolio and thinking, I need to take some risk off.
Oh, yeah.
You've seen my pension.
I have. But if you've got time on your side, Ange, then you you can ride the volatility. Yeah.
Oh, I'm not sure if my heart can take it.
I have to put up with it in the office, everyone. So.
Aaron is my go-to person whenever I rejig my pension portfolio, which happens twice a year, trader friends, twice a year during Halloween, because it's easy to remember and normally it's a slow period.
I usually get a Teams message, hi Aaron, 3 dots.
Yeah. Hi Aaron, I'm coming over. And also during the sort of April period is also pretty good. But, we often say you want to try and do that kind of as often as you go to the hygienist, right? So think about it that way.
Definitely, yeah.
Some of you have the luxury of time, trader friends. You can do it a bit more, but for those of us that have to be here 24/7, 5 days a week, that kind of thing, we have to put those dates in mind. Also, all this happening, I was crunched the S&P 500 just to show you a very quick, like monthly return. Year to date, around 17%. We're still Aaron, right? Despite the tariff tantrum. And let's be honest, this tariffing thing is a new, especially with exports, is a new phenomenon, trader friends, because normally you would do this to an enemy of the state. Normally you would hit a country that you either,
Well, it's protectionism.
Yes.
That's economics 101. You put tariffs on to protect your goods, and they can be quite belligerent.
Yes.
Because it's basically saying, well, my people aren't going to buy your goods because they're now more expensive for my people, so we're going to do it internally. So and
that's, you've hit the nail on the head. And not only is it that, but we're also seeing this almost like metaphorically speaking, the kissing of the ring. You know, we've seen Apple CEO, right, heading to the White House.
Yeah.
I think it was Boise earlier on saying Louboutin as well. I mean, goodness knows who else is going to kiss the ring. Trader friends, if you guys know, let us know here. And they all seem...
these you know, S&P 10 companies, I'd say, or S&P 50 companies right at the top are really caring about their earnings growth. You know, we've seen this earnings season was strong. They want to keep that momentum.
Strong, right? 82% earnings beat.
And we got something like 8% growth, which where about 5-6% was expected. So really strong. Part of that is definitely due to the tariffs not being as implemented as you know, expected. But these companies are so keen to continue to grow their share price for sure and grow their operations. And the best way to do that is to negotiate some kind of deal with the White House and to kiss the ring, as you've said.
Andrew McKilvey, hello. Andrew saying, Andrew, my portfolio is still suffering from long COVID. Actually, my portfolio is doing the reverse because during lockdown and, you know, the first time we had Wuhan and then everyone had to like grab stuff like there's no tomorrow and go home. My thought process was everyone's stuck at home, thinking the end of the world is nigh, but I'm surrounded by 4 laptops and lots of chips. So I went full in.
I enjoyed myself as well.
Mag 7, when a lot of people went, "What are you doing, Ange? That's not the way. The world, end of the world is nigh." I'm like, always go long.
I think as soon as I saw the amount of stimulus and the monetary policy going to zero, I was like, well, this is the equity markets are going to absolutely lap this up. So I also took advantage, even though you know, it could have been zombies outside.
Andrew McKilvey had 4 screens, 2 cameras, really high-tech ones, 2 green screens, all being delivered, keyboards, everything to my house. I was kind of like almost suffering from chip radiation. So there we have it. The other thing too that I want to bring to your attention, trader friends, is that, you know, the expectations of a cut for the September meeting. This is from the Fed. Still very strong there, right? And we still see techs. The techs really, every single time I think, you know, with all the AI stuff, you know, maybe it's time to move to the stuff that AI can't do, like, you know, hardcore manufacturing. You know, we had
oil and gas maybe.
Oil and gas. But Will Nutting on yesterday, and, you know, he made some really good points, like, you know, you still can't get AI to, for example, clean your wounds, right?
Yeah.
You can't get AI to construct a building, not yet anyway. So I was thinking maybe at some point we see that cycle into this industry, but we're not seeing that just yet. And so from your portfolio, you know, eagle-eyed view, do you think it's still kind of we keep the focus on tech, on the AI play, and wait before that cycle into utilities, for example, into industrials, you know, start again in a big way?
Yeah, I mean, it's a good question. I think that with the AI story, it's certainly not going away, and it's certainly revolutionized many businesses and many just general people's lives in terms of the convenience of AI services. But I think with AI, you've got to be aware of the valuations. You've got to be aware that probably all the companies in this space, a bit like .com, although this I don't think is quite like the .com crash or the .com bubble, will be as good as others. So that's something to be aware of. But look, in terms of portfolio construction methodology, we are looking for diversification. So we want to have lots of different slices of the pie here. We're not looking to go all in on one trend, even if we might slightly overweight it. But you know, with our S&P 500 position, we've got sort of 40% of that is in Mag 7, which are mainly dominated by AI technologies. So we're very much aware of the trend. We think there's a positive trajectory of it. But simultaneously, we're aware of the valuations in that sector, and you know, we've got plenty of diversification across geographies and across asset classes as well. So bonds, fixed income, gold, commodities as well, and a nice spread across our equity sleeve as well.
So just taking a look here, trader friends, at some of the tradable events for you, where you can use a lot of Aaron's advice and put that into action. Obviously, we got CPI later today. You could go and
That's a
trade
very
this on
big
bonds
one.
front. Yeah, really big. I mean, this could change the mood
I think
music.
particularly following on from that non-farms that we had almost 2 weeks ago, which came in very strange. Not strange, but it came in a bit. Jobs were lower than expected by quite a long range. So, yeah.
Bigger Beers, good morning to you, saying social media has been ablaze with 80s US President Ronald Reagan talking about tariffs and how the Republican Party was once very much against such protectionism. That's right. It's completely, tune change. This is a new thing, as Bigger Beers and Paul, welcome to the show. Especially when it's kind of so broad-based.
Yeah.
Normally it's against one, maybe two nations, right?
Yeah.
This is just all of you.
Yeah.
All of you.
And you're almost happy if you've got a 10% deal now.
Yeah. So you're joining me with the all sessions, right?
Sure, yeah.
Yeah, fantastic.
Absolutely.
We got 5 minutes, but before we get to that, Phil, can I just quickly show our trader friends some of this is a bird's eye view to the rest of the week, trader friends. I've done this specially for you because you have it on one page where you can snapshot it and print it, do whatever you like with it. I tend to I have a wall that really annoys my husband. It's got lots of blue tack. Looks terrible because it messes up. He's very
I used to do that with A-levels. I used to have it, particularly in like the toilet or wherever, I'd have like equations.
Oh, behind the door.
Yeah. So A-level around my kitchen, living room, one by my bed. When on the ceiling, I think I had the formula for like standard deviation or something.
Oh
so
my
I couldn't
God.
forget it. So even at bed at night, I'm having to memorize formulas.
Wow, there you are. So we have China tariff deadline, of course, that's already been extended. You can, depending on how you want to trade this, if you think that, there will finally be a deal, you could go long China ETFs. I put some trade strategies at the bottom for you. This is not financial advice, trader friends. This is just giving you a couple of ideas that you can research at home on your own.
Beneficiaries, potentially.
Yeah, exactly. We got major, this is what gets me excited, earnings, and also consumer stocks of Walmart, Home Depot, some of the ones that I always trade during retail earnings season. And also, because I go to the States a lot, I always do my research when I go there. You can take a look at that because we have that Tuesday through to Thursday. And then we have Cisco earnings as well on Wednesday. And Aaron, take us through the big finale on Friday.
Trump, Putin, Alaska summit.
Yes.
That's going to be interesting.
That is going to be interesting. So, trader friends, are you going to be on the Bill Blaine side of things where you think it's going to be a fudge and we'll get some sort of deal come through? Or are you going to be on the John Mayer side from SP Angel, our mining expert, where he says it's going to be very tricky. Neither side are going to want to.
I thought you meant the singer there for a second. I haven't heard him pop up
Do you
about
think
this.
we're going to get a deal? Do you think we're going to get some sort of deal?
Yes, I wouldn't be surprised. I think Russia, have been trying for a few years now to take over large swathes of Ukraine. They've achieved some of that, but they haven't achieved all their goals. So I think a deal could be likely.
Right, stay where you are. Go get a coffee, go get a tea. But we'll be right back with the all sessions. No time for coffee. Hey, trader friends! No time for coffee because we have all sessions coming up any moment. Now, you got the bell?
It's here.
You all
Sure,
set?
sure.
All set. And we have
grab a
a
pen.
minute to go. I'm just going to get my screen up and ready. It is going to be a big day because we have got not just CPI, we've got slightly risk on at the moment, has been said, but very near break-even levels for many of the indices there. Many investors and traders not wanting to take big bets ahead of that CPI number. Producer Phil, do we have a countdown? 30 seconds to go. Some of the key stocks we'll be watching out for, of course, because it's a big retail week. Walmart, Home Depot coming out with earnings. We'll be looking at that ahead of the game as well.
I'm quite intrigued to see how some of the big tech names move in anticipation for the inflation figures, because obviously they're growth companies and they're obviously driven, their valuations are driven by the discount rate, and inflation drives whatever the base rate, which is the discount rate.
Yeah. What's also key will be, here we go. What will also be key, of course, is any comments that come through from the Moscow side and, of course, from the US as well, because they'll be sending their envoys ahead.
Definitely.
That's how this normally works, trader friends. They send their mandarins forward to before that Friday meeting. Right, take us through the big movers, Ron.
We've got Chipotle up 1 1/15%. IBM up 0.16%. Tesla is up about 0.6%.
Yeah.
And then we've got a couple of down moves there. So we've got SoundHound down -1.7.
Yeah.
Him and Hers, which has gone through a bit of a tricky time, is down about 50 basis points. Oh, here are some of the big ones.
Yeah.
Virgin Galactic up 1.7. Tilray is up 10% in all sessions, which is a large move. Starbucks up around 1%, and Moderna up 0.8%.
What's also interesting is that Starbucks is up 1%. I wonder if that is because we're starting to see some traction on, have you heard about this whole protein thing that Starbucks is trying to cling on to?
Oh, is it like protein coffee or something they're making?
Yeah, because it's had this
I mean, if
terrible
18-year-old or 19-year-old me would have probably spent all my money on that back in the day, because I think anything labelled protein is a big selling point if you're getting into the exactly back in the day. Yeah. I mean, I remember at uni they used to sell protein Mars bars, which I don't really know how they worked, but it definitely could capitalise on the right market if they pitch it right.
Yeah. Let's have a look now at also Intel, closer look at Intel, because it is up 3%. Let's show you the minute chart there to give you a quick bird's eye view. Intel, of course, this is coming after the kissing of the ring.
Yeah, absolutely.
We need a sound, a kiss sound. And Intel shares rising after Trump says he met with the CEO, and this is Libutan. And I've read somewhere, trader friends, that he's actually Malaysian Chinese. If any of you can confirm that for me, that would be great, because I just read that over the weekend. But apparently Trump or one of his company, his circle, mentioned something that suggested that unfortunately Libutan had the unfortunate Chinese DNA in his,
Terrible.
I have no idea whether that was true or not, but it was something that crossed the headlines at the weekend. So let me know if that is true, trader friends, because I have not cross-checked that. Let's have a look at some of the other movers here, if I may, because it is looking like a slightly flat day, at least early on.
The ring kissing seems to be driving share price, which is interesting.
The ring kissing thing. We ought to own that and do a
trademark it.
Yeah. How to trade the ring kissing. Tilray is up almost 11%. Moderna also coming back up 2/3%.
Yeah, you've got some decent moves there, which is quite interesting given the fact that we've got very big data coming out today.
Yeah.
So.
Just checking to see whether Andrew's AI filter has come up with anything interesting. We've got some. A lot of European names that are moving, but in terms of the US, it's looking pretty quiet out there, perhaps ahead of that CPI number. Let's have a look at the losers now, because that's shaking out a bit more. Aaron, take us through the top.
Got Neo down almost 3%, SoundHound down 1.75%. Beyond Meat, which has also had a bit of a tricky period, is down 1.5%. Novavax down 0.7%, and Walmart is just down 0.25 percentage point, which is interesting because it's a big week for retail, as you mentioned.
Yeah, let's just check out whether Home Depot is... Yes, Home Depot, there we go. It's also just slightly lower. Monkey Man, hims and hers is also low, but Monkey Man, I'm a bit worried about Monkey Man, trader friends. Haven't heard from him recently. Is he all right? Anyone know where Monkey Man is? Please, please let us know. I'm worried about his safety. Speaking of which, we have Big Bear AI as well. Have you seen Big Bear AI down 29%, all sessions there? This is after the company cut its full-year sales forecast, withdrawing its adjusted EBITDA full-year guidance.
Yeah, big move there to see that in a day. Huge.
Let's try and add that to the workspace for you. This is a 1-minute chart. Let's have a look. There we are. So this is currently down 29%. Across Europe, let's just give our trader friends a quick readout of the scene here in Europe. Aaron?
Sure. So Europe, I mean, Germany 40, we got is just up marginally, 0.05%. Wall Street, well, that's not Europe, but it's up marginally as well. If we look at, say, France 40, that's up around 0.5%. FTSE is up 0.2%, and the EU stock 50 up 0.2%. Right.
And trader friends, if you have any requests that you'd like me to look at, for example, after this, I'm going to look at some select stocks that you can look at. For example, if you think there's going to be an amazing, I can't do his accent. You guys got a Trump sound thing on the soundboard? Amazing, big, beautiful deal on Friday.
That's what I do. I make deals.
Go on Friday, and we've been looking at some, or at least I've been looking at some proxies in Turkey that might benefit, right? If there is a handshake and lots of pictures that greet you on Saturday morning, that sort of thing, but also some of those that could falter if we don't get any sort of good news out of there.
Love to be a fly on the wall in that room.
I know, right? Yeah. It's
although my Russian is very lacking, so I don't think I'll be able to understand much.
There'll probably be a lot of, small talk, and they'll go through each and everything with a fine-tooth comb, saying, "Tick. Have we talked about this? Yes, tick." Meaning we're not going to talk about it. Tick. Have we talked about tick? And then in the final 2 minutes, they'll get down to business, basically. Julian, good morning, saying Trump will fix it. Well, he certainly has the breadth and the size to make it seem like
Monkey Man is safe, by the way.
Oh, good. Thank you, Jagger or Jagger. He's fine. Okay, that's good. Phew, we can sleep easy now. I was wondering. Intel, let's have a look at that, because that's I spoke about that earlier, because Intel is tracking higher. Just very quickly, this is yet again because of that ring kissing, but it's now
definitely. Up. 3.5% is a big move, and I think it will compel other CEOs, certainly in the tech space or in the large cap space who are
pucker up.
Definitely. Definitely, yeah.
Yeah, and on that note, puckering up, we've got Art of Investing coming up next. This is episode 4, and it's when they put together a portfolio. Very exciting stuff. So that is next week. This coming week, it is bonds and commodities, which is a great time, especially with that CPI number about to come out. So stay with us. It's coming up next.
This is designed to teach people the skill set of making 10% every year, whether the markets are up or down.
All of the gold that had ever been mined throughout time, you could put it all together and put it in an Olympic-sized swimming pool.
If you had $1, it bought 20 times as much gold 50 years ago as it does today.
Meta are going to spend $70 billion this year on AI-related expenditure. And Microsoft, $120 billion.
This sounds all a little bit dangerous to me. Copper down 20% in a day, oil going negative.
China today still buys more than 50% more than half of all the commodities in the world.
Definitely yellow card for that one.
Almost a red card, actually.
Your capital is at risk. The value of your shares, ETFs and ETCs can fall as well as rise, which could mean getting back less than you originally put in. This content is for information purposes only and is not investment advice. Past performance is not an indication of future results. Welcome to episode 4 of The Art of Investing, entitled All That Glitters. This is brought to you by IG, the global investing platform. And as always, I'm joined by my co-hosts. No, it's not a Werther's original advert. It's Chris, CJ Fellingham, and Mark Spice Holden. How are you, gents?
Hi, Rich.
Very well indeed. Thank you, Rich. Looking forward to this one.
Now, why have we entitled this episode All That Glitters, Chris?
We're going to be talking about various forms of gold in the loosest possible way. We've got black gold, oil, green gold, copper, gold, but also the new phase for digital gold, which is Bitcoin.
Excellent. Right, I'm getting the picture. So it's the commodity special. And what we're looking at, of course, week 1, we looked into equities. Week 2, we had our teaching from Commander Bond across here. And now we're doing the last of our deep dives into the asset classes. And that's ahead of next week, the big launch on the portfolio. So today, as you might have noticed by now, we go into markets every week and go through what's been the big stories of the week. And the reason for that is, of course, we're launching our own live portfolio next week using all the asset classes that we've spoken about in the last few weeks. Then today, we're going to go through our commodity special. And then finally, ahead of the big launch next week, we are going to introduce some of the names of the ETFs, of the instruments that we're going to use in that portfolio. So what has been happening in the markets this week? CJ, this could be a whole episode in itself.
Well, it's been an absolutely huge week for data and for company reporting. There's been an avalanche of company reports from all around the world. And we'll just touch on a few of them because there are way too many. For example, there's 25% of the S&P 500 are reporting this week. That's just, that's 120 to 125 companies, which is just amazing. And that's happening everywhere around the world. The great news is that actually, on the whole, those results have been pretty good. So you've seen NASDAQ and the S&P 500, the two biggest stock markets in the world, hit new time highs again. And I repeat myself from last week, here we go again. They pushed up. Now, to give you some context, NASDAQ is now up 45% from its April the 7th low.
Wow.
And the S&P 500 is up 34%. Now, these are massive markets. The S&P 500 is capitalized at $56 trillion. So it's absolutely enormous. And even the FTSE 100, once again, here we go.
Right.
Cheer. FTSE 100 hitting the all-time high. There we go.
They said it would never happen.
2 weeks in a row. Gosh, can it make 3? Let's see. Anyway, all the other markets have done pretty well. They're also consolidating towards their all-time highs. But probably the biggest shock we got, and we'll go into this in a bit more detail when we talk about commodities, was the copper price had its biggest ever fall, single-day fall. It fell over 20%, as we're reporting now. Last night, it fell 20% in a straight line. And that's because Donald Trump came along and basically changed the tariff regime for copper. Basically saying, well, yet again, he basically said, look, you can bring basically raw copper, unrefined copper, if you like, into the US without a tariff, because we want to manufacture it into things like copper pipes, etc., in the US. And that's what he's trying to do with all this tariff, is trying to bring manufacturing into the US. But if you have manufactured it outside, then you're going to stick to a 50% tariff.
Just call that one back just to show how Donald says one thing and then thinks on his feet, or maybe doesn't think on his feet. Somebody else does a little bit of work in the background, says, Donald, that wasn't the most sensible thing you ever said. And then he changes, because he started off saying anything to do with copper had this tariff on it. Then he realised that it takes 25 years to mine any copper. You want to build a new copper mine, sink all the investment in there, do all the stuff, takes 25 years. We can't do that in the short term. So let's change the rules.
Absolutely. He's obviously had a lot of American executives whinging at him that, it was going to hurt them. And quite rightly so. I mean, copper goes into so many things, house building, wires, AI stuff. It's
and
everywhere.
the new data centers and the
data,
electric
absolutely.
cars. And
yeah, I mean, it's one of the, the biggest commodities out there, and a very valuable one, obviously. So yes, he sort of, threw the cat amongst the pigeons last night. When we spoke last week, we were all waiting to see if he was going to give the European Union a favourable tariff deal. And we were guessing that it would be the same as he gave Japan earlier in the week. And he did. He duly delivered with that, a 15% sort of tariff for Europe. So that was good. European markets reacted accordingly and just rose a little bit on the back of that.
how did that go down with individual countries in Europe?
Well, I'm not going to get into European politics, trust me. That's for another podcast, maybe at Christmas. And my kids will never forgive me. The more shocking one was that actually India, obviously who now have the biggest population in the world, were hit with a 25% tariff. And they were hoping for a 19% tariff. But just to show you that this is all getting behind us now, the Indian stock market basically fell about 1% when it was immediately announced and ended the next sort of 24 hours actually higher than that.
Okay.
So it shows you that sometimes there's a saying in the markets, it's better to travel and arrive. And, in this case, people had expected it probably to be a bit worse than anticipated. And it was. So the market said, OK, fair enough. And on we go. Let's look forward to the next.
And at last, can we put tariffs behind us? We put them to bed and that's it.
Personally, I think we probably have. I think any news now we get on tariffs, apart from the ones that surround Russia, because there is, and this is going to talk about in some of the commodities particularly, but countries who are buying resources like oil from Russia, like India are doing, by the way, then in China, they might get additional tariffs put on them because they are trading with Russia. And basically Trump wants to bring that war with Ukraine to an end. And he sees the tariff threat on those other countries as a way of putting pressure on Putin and co to end that war. And that, if he does that, then that's great because we don't like war.
Can I say a couple of things there? One, on the tariffs, I don't think we can put them to bed because I think that Trump has shown how easily he can bully the rest of the world. And so any other issues that come along, he'll just say at some stage, well, if you don't cooperate, we'll put some more tariffs on you. The other thing I would say is Mark said something very important there with regard to a city saying better to travel than to arrive. Mm-hmm. It's a saying that's been around for years and years and years. And essentially what it means is that the market's job is to anticipate things before they happen. And this goes back to one of our first episodes where we talked about the fact that people get surprised that when some results come out, the market goes down rather than up because they were great results. And it's all due to what has been anticipated and what then that happens. So an old city saying, better to travel than to arrive means we've now got to the stage where the news is there and it's all been discounted already.
And it's been discounted. So unless something happens that's completely unpredictable, like the Black Swan event, then generally the process is it's being priced in as we move along. So when you arrive and the actual headline comes out,
it's not new news.
So there's been an avalanche of results from around the world. I think I'm going to pick just a few out here, but Europe's biggest company until a month or two back was Novo Nordisk. Now, those of you who want to lose some weight, they do this great weight loss tablet, or what they're trying to introduce as a tablet. It's an injection at the moment.
A subject close to your heart or your stomach.
Some say I've lost weight. Some would say I haven't. But there we go. Anyway, either way, they basically had a massive profits warning. Now, we were talking about expectation management last time. And if you remember, it's better to sort of get numbers low, then you beat them, and then your share price should go up. Well, Novo Nordisk cut their revenue forecast for their two biggest drugs by 30%, 30%. The shares fell 25% as a result. They're very poor expectation management. And the last time they reported was only 6 months ago. Yeah. So clearly they've disappointed people. It was Europe's biggest company. It's no longer. It's now the second biggest company behind basically German software company SAP is now number one. And ASML, who we talked about last week, is basically the third biggest one. But really the big results of the week, which we highlighted were coming last week, are the two of the big Magnificent Seven. Meta, which is Facebook to a lot of people, They had magnificent results, as did Microsoft, and we all know Microsoft, of course. But both of them absolutely smashed forecasts. As I speak this morning, I'm looking that Meta share price is up about 11% as a result. They beat their revenue. They 20% revenue growth. This is the fourth biggest company in the world. Microsoft did 18% revenue growth. These are massive companies. Market caps of nearly $4 trillion. Microsoft shares are up 8%, or give or take. And they're spending, get this is enormous, and this helps other things in the AI sector. So Facebook are going to spend, Meta are going to spend $70 billion this year on AI-related expenditure. And Microsoft, $120 billion on AI-related things. So guess what? NVIDIA, the biggest supplier of AI chips, also went up a couple of percent as a result, and that helped push NASDAQ to this all-time high that we saw overnight.
Okay, right. Well, whose job is it to keep everything under control? Jerome Powell. And we heard from him in the last 48 hours, didn't we, CJ? What did the Fed have to say?
The Feds had their meeting. There was no surprise in the sense no one expected them to cut rates, but he was fairly hawkish, created a bit of concern in the market that maybe rates would not move down at the speed that they have done in the past. There were two people who dissented from the decision, obviously, and they both wanted lower rates. They obviously want his job, so they were positioning themselves for that.
And just explain what you mean by that.
Well, Jerome Powell's under a lot of pressure from Trump for not doing what Trump wants him to do. So Trump has talked about getting rid of him, but he's sensibly realised that next year that Jerome Powell's contract ends, and so he will then be able to appoint a new person. So anybody who wishes to be on the Donald Trump birthday list, the Donald Trump list of who could be the next chairman of the Federal Reserve, would presumably want to get in his good book. So they're voting to say, we think rates should come lower in order to get in the right spot.
And it's the first time since 1993 that you've had two people do that. This is
correct.
That's a big event. Now it's time to go on to the rest of the asset classes that we're going to introduce to the portfolio, and that is commodities.
Let's start with a really basic overview of commodities. All commodities are priced in US dollars, all right? So you can use pounds to buy them, but you have to translate it in dollars and buy that. So as a rule of thumb, when the dollar falls, commodity prices tend to go up. So you have to, as an investor, have quite a good view about what's going to happen in the dollar. And when we come to talk about our portfolio next week, you'll obviously hear us talk about a view of the dollar, because it's absolutely important, because there's so many dollar assets in the world, and commodities are the biggest chunk of them. In fact, commodities are actually, as a whole, bigger as a group than all of the equities in the world, and bigger than all of the bonds in the world. Not many people think that. But of course, commodities are dominated by oil and energy. That makes up about 83.4% of the overall commodity market.
Wow.
And then precious metals make about 6 or 7% of that. And then industrial metals, which is things like copper, nickel, aluminium, etc., 4 to 5%. And there are other stuff like soft commodities like wheat and sugar and coffee. And we're not really cocoa, I suppose, absolutely. But we're not really going to talk about those, or rare earths, because they're such a small proportion of the overall market. And the things that are really investable for us are things like, copper, gold, oil, etc. And those are the things we'll be focusing on more than anything else. Commodities also don't pay dividends or don't pay an interest charge. And we've talked about it. Obviously, bonds pay interest. Equities pay dividends. Commodities pay nothing. In fact, it costs you to hold commodities most of the time, because you have to store them. They're big lumps of copper or iron ore or aluminium or gold or whatever it happens to be. And if it's gold or something valuable, then you have to insure it, and there's an extra cost involved with that. So it's quite difficult to value commodities. And it really comes down to supply and demand. And we talked about that when we were talking about equities and most of these assets. The more buyers you have and the less supply you have, that tends to push prices higher. And obviously, if there's too much supply and not enough demand, like during times of recession, prices tend to go down. So basically, it comes down to supply and demand for commodities, just like many other assets.
And those can be moved by politics, they can be moved by natural disasters, and you get a real swing from, as CJ alluded to, it takes years to get a new mine online and a hell of a lot of investment. So it's not like you can just click your fingers and turn a nuclear power station on. A copper mine takes years and years of planning. So, for instance, when we went through the financial crisis, suddenly in 13, 14, you didn't have a lot of growth coming on. It's a complicated equation to find where that demand-supply balance is, isn't it?
Yeah, I mean, I remember 10 years ago sitting down with the chief executives of Rio Tinto and BHP and some of the biggest mining companies in the world, and banging their table that they were not to spend money on new mines, etc., because they were the mugs. They just kept investing in new production, and it worked against them. So they kept oversupplying the markets, and the demand wasn't strong enough. So the prices of many of the commodities went down. Now, they learned that lesson. They overlearned it, in fact, and they pulled back massively from all this capital investment that they were doing. And so now, if you look out, and we'll talk about copper in a minute, for example, you can't see any new big mines coming on for copper for the foreseeable future.
Right.
And as you say, even if they started today, found a new sort of copper deposit and took it to market, it would take, give or take, 19 years if it's outside the US. But in the US, because of the regulations are much stricter, etc., ironically, then it might take 25 years. So there is no new supply coming for a while. And, copper is a major beneficiary of that, I would say. Just jumping into things like the industrial metals like copper, aluminium, iron ore, etc. To give you an idea, China today still buys more than 50%, more than half of all the commodities in the world. Half. That's amazing. If it's something like iron ore, they actually buy about 75, 3/4 of all the world's iron ore, and they turn it into steel, and they've obviously got big building construction projects, etc.
And a lot of Australians get paid a lot of money just to drive trucks and trains.
They do. Although they asked for too much money, and then they introduced remote control vehicles. So they sort of shot themselves in the foot a bit there, I'm afraid, the Aussies. But, things like copper, even copper, they still buy over half of the world's copper. Right, China cannot be ignored. So the last time we had a massive super cycle was in the early 90s. And Rich, you'll remember because you were in the business at the time. But, then you had massive moves up in all of these commodities because China was going on a huge growth project because they'd basically been let into the World Trade Organization, whereas before they'd been kept out of it. And so they went for growth, basically. And for 5 years, these commodities went up hugely in value. And it was very impressive. They still, like I say, buy more than half of all the world's commodities. So they cannot be ignored. And China have been having a tough time in the last few years. They've had deflation, they've got unemployment, their economies, they're struggling to get any growth going. It's been coming down and down and down. And so it is an important factor. And now when you look at sort of the metals, if you were to rank the sort of what I'd call the industrial metals, but iron ore, for example, is the most economically sensitive. Then copper and aluminium are very high as well.
Okay, so what I'm hearing, if we hear anything on Chinese stimulus, that's one time that you might be interested in buying commodities.
Well, it's got to be the right sort of stimulus. So it's got to be about infrastructure building because things like copper go into electrical goods and into building houses. The amount of copper wiring in your house is enormous. There's miles of it. And, things like steel making go into things like that. So, yes, it's very important. Construction, steel making. And as long as they're spending the money in the right way, then that is beneficial potentially for the commodity markets.
Now, you said that oil was 83%, oil and energy, 83% of the total size of the market. I remember a time when it gives you the perfect example of supply-demand economics, where the supply was, stable, but the demand collapsed during COVID because we all stopped even leaving our houses. Did the oil price go negative just after that?
It was a little bit before COVID, but it was around the global financial crisis. And basically what happened was the Americans particularly had pumped so much oil, they'd run out of space to store it. Now, if you get oil out of the ground, you pipe it to a refinery. The refinery turns it into a different product, sort of a different sort of oil, lighter or heavier, that goes into airplanes or your car or petrol, whatever. But you've got to store it somewhere. And all the storage in America was full. So actually, it's very difficult to stop pulling oil out of the ground. Once you start pumping, you can't stop it. It's very expensive to stop. So the poor Americans, let's feel sorry them for a moment, the 10-gallon hats down in Texas.
That's a yellow card for that one.
Almost a red card.
The poor Americans with
That's a fair comment. That's a fair comment.
all-time highs.
most of the Texans, etc., were drilling baby drill, which is obviously Trump's got them doing again. They were just producing all this oil and they had nowhere to store it. So they were literally paying people to take it away. And we hit a moment where West Texas Intermediate, which is the main American type of oil, in Europe we have Brent, that came out of the North Sea, the Brent field in the North Sea.
Right.
So Brent oil tends to be quite heavy and is UK and European based. And the Americans use a light oil, which is it's a West Texas Intermediate. Well, West Texas Intermediate went to a negative price. I remember vividly, I was actually in Houston at the time, and I rang my mate at IG, Chris de la Vega, top man, and I said, Chris, I want to short these.
Oh, really?
What happens if it goes negative? Will IG make me a price that is negative, that allows me to make money when it goes negative? And he was right on the button. He came back and said, absolutely. And sure enough, I shorted it, and I was very lucky, because you've got to get lucky on some of these things. Yeah. And the timing, I happened to be in Houston. I saw how much pain they were going through. It went negative to about the tune of about $2 or something like that.
Wow.
So I was able to buy back my position that I was short and make a lot of money. I was very happy with that one.
It is time to move on to gold, because we have had a suggestion of what the penalty will be for a red card. And that is, CJ, tell us what will happen to Mark.
If Mark gets a red card, then I'm going to cut his hair off.
Are we talking a little or a lot?
No, it's all coming off.
It's all coming off. A number one all over. Well, you look quite similar at that stage. And if CJ gets the red card, what is going to happen?
I'm going to make him wear a wig, a Bee Gees wig. He's going to have to look like,
for the whole episode.
Like he's staying alive for the whole time, yeah.
For the episode.
For the episode.
I can live with that.
I think there will be a few people that have worked with you in the past that would very much enjoy that.
Right, so let's go to precious metals. So commodities, a big chunk of that, if you remember me saying about 7 or 8% of the total commodities market is precious metals. That's gold, silver, platinum, sometimes palladium. But basically the big chunk of that is gold, and that makes up about 3/4 of the precious metal market. And we all know gold, most of us wear it. Anyway, let's go back to basics. Again, gold is very difficult to value. But if you look at the end market for gold, about 45% of the end demand comes from jewelry, and about 25% comes from investors like us. If we were going to invest in gold, you can buy gold bars, you can buy sovereigns, you can buy Krugerrands, you can buy ETFs, etc. But so about 25%, a quarter of the market, the demand for gold comes from that investment side. Then you have these people called central banks, which you've talked about, the Federal Reserve, the Bank of England, etc. They have reserves. They have to diversify their assets, a bit like we're going to do in our portfolio. And they buy gold as well. Traditionally, that's what they've always done, and we'll come on later and talk about Bitcoin. Will that begin to replace some of those holdings? But at the moment, about 17% of all the world's gold is held by central banks in their reserves. So there's not a lot of it to go around, and then other stuff goes into technology and drugs. Gold goes into drugs and tablets and things like that. It's got a pretty diverse usage.
Take us through what Gordon Brown decided to do with our gold reserves.
What a star he was. So yes, back in the when he was Chancellor of the Exchequer, he publicly told the world that we were going to sell down our gold reserves. And so, of course, the market makers and the market sort of got ahead of him, pushed the price down and down and down. And the minute he put his hands up and said, we're all done, we don't have any gold reserves left anymore, the price went shooting back up again.
And it's never been there since. $220 an ounce. And what is it today?
3,300, yeah. So that was the low, pretty much. What a star, eh? There we go. Let's move on quickly.
But central banks have been back in the market buying in the last couple of years, haven't they?
They have. People the growth economies like India, like China, have been in buying gold for their reserves. And China started with no gold reserves, and India have been doing the same. India love gold, by the way. So actually the end demand, because jewelry demand is so big in India, that the Indians are the biggest buyers of gold as a country. They buy about 30% of all the gold out there. And China buy about 25% of it. I don't know if you know, but if you go around Beijing and Shanghai, they have vending machines with little gold bars and gold coins in it that you can put your cash in and you can get gold out in vending machines.
As you can in Harrods here, so I've heard from a friend.
Well, they wouldn't be in the East End because they would have been robbed by now, as they say in the book.
In fact, there have been some gold heists
Yeah.
in London over the years, haven't there?
Brinsmack, yeah, absolutely.
Brinsmack,
Brinsmack, yeah, it's been very good. So yeah, together, India and China account for over half of all the gold demand out there. And the rest of the world is only 45%. Gold can't be valued because, like all the other commodities, it doesn't pay a dividend, doesn't pay any interest. And to store gold, because it's valuable, you have to insure it and you have to sort of put it somewhere. And that charge, it can sometimes sort of be quite costly, particularly if interest rates are high. So if interest rates are high, you've got to worry that actually you're going to have to pay a lot to store in Hatton Garden or wherever you might want to hold your gold. So physical gold can be very expensive to shore, and interest rates can hurt. So we have to be aware of that sort of thing. The supply side, a bit like copper and some of these other commodities, the mining companies have been very reluctant to invest in new production, so the supply side is quite constrained. And I'll give you a little thought here. When I first joined the city, there was this urban myth that you could, all the gold that had ever been mined throughout time, you could put it all together and put it in an Olympic-sized swimming pool. Now,
And it's a myth.
It's a myth. It's not far off though.
Okay.
So I have checked this out, and apparently you could fit it in 3.5 Olympic-sized swimming pools. Or, to give you some perspective, the dome of St. Paul's Cathedral would only be about half full if you put all the gold that's ever been mined in the world in there. So if you've got some on your finger or in your grandma's sort of jewelry box, don't get rid of it without thinking about it. It's worth a lot.
I'd like to take a moment to make you aware of an awesome offer IG is currently running. Until the 15th of August, IG is giving away a free UK share bundle to all new customers worth up to £100 when you invest just £20. Sign up for a general investment account, a stocks and shares ISA, or a SIP and make your £20 investment to get started. Your capital is at risk. The value of your shares, ETFs, and ETCs can fall as well as rise, which could mean getting back less than you put in. New customers only. Offer is valid until the 15th of August for ISA, GIA, and SIP accounts. Other fees may apply, and T&Cs apply. Fantastic. Now, what about those beautiful bitcoins? Take us on to the digital gold, the gold of the future, or is it, CJ?
It seems rather quaint that the oldest person around here is talking about the youngest gold asset. And so it falls on me to talk a bit about cryptocurrencies and Bitcoin. First of all, let's all have a little bit of a health warning on these things. Cryptocurrencies are digital assets, but they're traded on unregulated exchanges. The assets are therefore not regulated by anybody. They're very high risk, and people need to understand that they are risky and they are volatile. Bitcoin itself was the first cryptocurrency, or digital token, as I think it's more accurately known. It was created by a chap called Satoshi Nakamoto in 2009. No one knows who he or she really is, although some suspect it might be spicy.
If only. Do you think I'd be sitting here if it was me?
Yes. By choice.
Because you want to give so much back, Spice. That's what
Obviously.
it is.
Widely believed that the creator or one of the creators is English, because in the original paper, then words like colour were spelled the proper way.
As always, the conspiracy theorists will find something to back up their view on what's going on. I hadn't heard that one before. That's one to go into my scrapbook.
Perhaps Scottish.
They are created by Bitcoin miners who police the Bitcoin blockchain.
Chris, you just introduced a new term there, the blockchain. Take us through exactly what the blockchain is in relation to Bitcoin.
A blockchain can be thought of as a ledger, a digital ledger. And how can I bring that to life a bit better? A ledger is where records are kept. So think 100 years ago. You're going to your bank 100 years ago. There's someone who looks a bit like me, sitting behind a high desk.
Probably your brother, was it?
Or with a quill in my hand, marking money as it's coming in and marking money as it's going out. And I've got a ledger in front of me, and it's being done by hand. And that's how all these things used to be done in the old days. In an electronic world, when you put it onto the computer system, this will be called a blockchain. The system is built to police itself. So it is, and it is decentralized. So there's a computer coding that's working in the background, making sure that things are only being marked onto the ledger when they have been agreed by all the participants, and they are the Bitcoin miners. The first person to agree that block, and everybody else then agrees it, wins a little prize of some Bitcoin. So the Bitcoin miners make sure the system works. The system is completely protected in terms of coding, so nobody can muck around with it.
Mm-hmm.
And that is your first example of a blockchain. And there is a limit to the amount of Bitcoin that ever can be created, because it's going to get more and more expensive. Over time, it gets more and more expensive through a process called halving. We don't need to go into technicals of that in a moment, but it gets more and more expensive. There can only ever be 21 million of them. And there are 19.7 million at the moment. As with all cryptocurrencies, Bitcoin included, they're very easy to trade on these exchanges, but it's very difficult to get money from your bank to a platform, because given the reputation that cryptocurrencies have got, it's a very highly regulated process. And so when we think about how are we going to reflect positions in this world, if we want to have any within our portfolio, we're going to be thinking in terms of an ETF or buying off a platform such as IG. Why is this even relevant? I mean, there's this digital token that exists in the ether, let's say, somewhere. Why is that even relevant?
Mm-hmm.
Right? What we need to understand is that one of the goals of wealth creation is to protect the power of the pound in your pocket, or the dollar in your pocket, or whichever currency you are investing in. Unfortunately, the history of the global financial system is that when the going gets tough, politicians and central bankers tend to print money and their currencies tend to fall. And just some examples of this, just to really make this clear. Did you know 50 years ago, the pound traded against the dollar at 2.4? Wow. 50 years ago. And here now we are with the pound against the dollar at 1.3, and the Liz Truss debacle got us down almost to 1.
Yeah.
The pound buys far less of anything than it ever used to. So although we may look at our numbers and say, oh, I've got this much money, I've got that much money, in terms of buying power worldwide, it's poor. The dollar, if you had $1, it bought 20 times as much gold 50 years ago as it does today. $1 buys 20 times less gold.
So it does tick a lot of boxes. One of the first things you said is that supply and demand is very important in this whole complex that we're looking at today. Now, you've told me there's limited supply of Bitcoin. There's only ever going to be 21 million. There's limited supply of gold getting dug out of the ground. The central bankers continue, along with governments, to give endless supply of more dollars, more pounds, anytime there's a hint of a problem that they might not get voted back in. And therefore, that is what I do not like about fiat. And if I don't like fiat, I like
That's not Fiat the car companies. That's not Fiat the car companies.
I don't like those either. I can imagine marking a little chinky Trento though.
You used to have one
Romeo, maybe.
You used to have one called Fearless Fred, but that's for another day.
That's a long time. I mean, I think it's really important, and Bitcoin is going to be really interesting to see how it evolves, because gold for hundreds of years has been something of an inflation hedge. As Chris says, gold has held its value against all these other currencies. So the inflation hedge means when inflation goes up, the price of gold goes up enough to compensate for you that. And, even in the last sort of recent times, we saw when Russia invaded Ukraine and there was a huge amount of inflation, obviously interest rates had to go up. But, the gold price is up 75% from where it was a month before the Russian invasion of Ukraine.
Wow.
It has protected you against all that inflation you've had. And remember, we had 10%, 13% inflation around the world. It's also great at protecting you during crises. So, it's notorious during wars, people take gold and they travel, and God forbid we never have to see that sort of thing again. But during the great financial crisis, gold rose 25% that year. When COVID happened, it rose 28% in the next 6 months. So gold has this habit of doing well when there's crisis and when there's inflation. And I think it's going to be really interesting to see how Bitcoin does during this time. Now, my instinct is it is the new digital gold.
Now, this takes us perfectly on to when we're going to set up this portfolio. There's going to be the big launch next week. What kind of instruments are we going to consider whether they should be in there or not? So we thought it worthwhile to put up a graphic today of 25 to 30 of the kind of ETFs and instruments we will be considering. Now, we're using all the asset classes. That's why it was so important over week 2, 3, and 4 that we did these deep dives into equities, bonds, commodities, gold, and Bitcoin. They are just, designed to reduce the volatility because, Chris, we're not going for racing against a benchmark, are we? We are looking at an absolute return. Just take everybody through what that means.
The plan is that we're going to construct a portfolio which will return 10% over the next 12 months. We'll be altering those allocations each week as we see fit, but that's the plan, to try to get to 10% or more, whether the markets go up or down. So we're going to have to really set ourselves a strict task. It's fine when equity markets are moving up and everything's fine. When they start moving in a negative direction, or they are moving in lots of assets are moving in different ways, we've got to catch the ones that are going up and try to be out of the ones that are going down. So let's hope it's a really easy period. We don't have to work too hard. But knowing how these things always work, it'll be fun and nice and easy for a lot of the time, and then suddenly something will blow up. And that's where we will be hoping to show people how live you can see the pain we're going through trying to make these decisions and decide what the right thing to do is, which should help our listeners with their own portfolios and what they're trying to do.
That's it. Spicy, you've got a wealth of experience in wealth management. Give us an idea how hard that is, because we're not just talking about making 10%. Somebody can make 10% in a couple of days, right, by having the right stock. But this is the design to teach people the skill set of making 10% every year, no matter, as CJ says, whether the markets are up or down.
It's incredibly difficult. And, people, just like you say, could go out and buy one stock and it goes up 10% in one day. And then if they were wise, they would sell it. And some hedge funds, I believe we were talking about earlier on, encouraged you to do that if you happen to have to make that money that quickly. But I think if you're with the wealth management industry, want you to stay invested. It's a natural thing. They want you to be invested because they get a fee out of what you are, what you've got invested with them, and they get fees every time they trade, etc. Now, there are rules about over trading, and there are regulators try and stop that sort of thing. But we won't be over trading unless we feel we need to have to. But we are very conscious about, as we've explored in our earlier episodes, the long-term returns you can get out of the different asset classes, and we know that equities are right up there, and they're the best inflation hedge, and they generate about 10% a year. And bonds give you about 4.6% a year, and cash gives you less than 3%. So with that in mind, imagine how the portfolio is going to be skewed if we are trying to make 10% a year over a long period of time. And that's what we're aiming to do.
Great. Now let's look at some of those assets. The wonderful graphic up on screen. If we're looking at equities, we wanted to have a breadth across Europe. So we've got choices there in UK, in the Eurozone, in Germany. Then further afield, of course, US large caps. We've got Japan. We've got China. We may want to be specific in emerging markets with some broad exposure there. We may want to be equal weighted. So take us through what the S&P 500 equal weighted is, Spice.
Well, you've heard us mention the Magnificent Seven numerous times now. Well, the Magnificent Seven, those 7 companies alone account for 35% of the market capitalization of the entire S&P 500. Now, that means that there are lots of other, there are another 493 companies underneath it that might be doing very well. Some of them might be doubling or trebling, but they're not big enough to make a difference in the top. But if you want exposure, a more even exposure, you buy what's called an equal weighted unit trust or ETF. And that means you have exactly, 1/500th in every single stock. And that way, if the Magnificent Seven don't do well and other stocks do, then you'll benefit that way.
And these are easy to find on the IG platform. You just use the search function.
Absolutely. And, look at S&P 500 equal weighted, and you'll get a list of things that you can invest in that will do that job.
And to get an idea of all the ETFs that are available, you can just search iShares, and there's pages and pages of them, along with other ETF providers. There's numerous, isn't there? There's VanEck, there's Granite Shares, there's
Wisdom
Wisdom Tree. Yeah.
I think we're going to be quite conscious. When I was a wealth manager, it's important to try and minimize the cost for your client. And we'll be doing exactly the same. So we're going to be looking for ETFs that do, or products that do the job, and they're cheap.
Now, take us on to how do we get exposure to fixed income here? We've got a couple of gilts ETF, in fact, 3 of those. Then we've got treasuries of different maturities.
I don't really want to see a sight in my mind again of the yield curve that we did last week with the 2 guys and holding the hands out together. But different parts of the bond market are influenced by different things. So with the bond selections, we can focus on the very short-dated bonds, if you remember, the ones really affected by interest rates in the short term, or the very long-dated ones, those affected by supply and demand, inflation, all those other things. So we will be talking it through next week where we want that exposure, but we're just giving ourselves the tools to be very precise in where we want our exposure to be.
Excellent. And then moving on to this week's specials, the commodities. We've got the iShares Physical Gold ETC, Wisdom Tree Brent Crude Oil. We've got copper from both Wisdom Tree and a daily hedged version as well. And then we go on to our thematic blockchain VanEck crypto ETF. Now, take us through. That's not quite Bitcoin, is it?
Yeah, so you can't put Bitcoin as such into an ISA. The safest way to buy Bitcoin must be to buy an ETF of Bitcoin. Then they can see who owns it. It's open and transparent. We can't buy that. There's one in the States, the BlackRock ETF, biggest, I think, ETF probably now in the world. In the US, you can buy it. We cannot buy that here. So the only thing we can really buy here are surrogates of it. And there's one thing called the VanEck Crypto and Blockchain Innovator UCITS. It essentially invests in lots of companies, all to do with Bitcoin. So Coinbase, MicroStrategy, all these other things. That silly thing of yours that one day you'll talk about, do a smarter web company or whatever. I'm sure that one day will be there. All these things that are very linked to Bitcoin are in there, but not just Bitcoin, the power supply, the huge computer investment, all that sort of stuff is in there. It's a volatile instrument, and it's pretty correlated to Bitcoin, but it's the best thing we can do.
Great. So, and then finally, we might want to have a little bit of cash, as most portfolio managers do. So we've got the Amundi Smart Overnight Return Money Market Fund in there. That just gives you a little snapshot of the choices that have to be made next week. It's going to be interesting. There's going to be a debate because I can already tell that we might not all see eye to eye. So tune in next week for the live portfolio manager.
The fighting portfolio construction meeting.
That's right. And it's exactly...
Bring it on.
Right, we've got a very quick question before we move on to the close of today. CJ, if I bought a 10-year bond, like you described the process of doing last week, so say I'm going to get a 7% coupon on that, right? So I've got it. I plan to hold it for the 10 years. Why do I care about the price movements from now until it matures?
In fairness, you answered the question yourself, which is if you're going to hold it till redemption, if you're going to hold it for the full period, you don't care. You don't mind where it trades in the intervening period because you're going to get your coupon every year and then you get your money back at the end. So you won't care. However, in the real world, we all buy things and then we suddenly think, maybe my view's changed on where I think interest rates are going to go, or maybe I need cash to buy a new car or a house or whatever, or maybe there's some other expenditure that I need to make. And therefore, I need to think about, should I sell this bond? And that bond will then have moved according to how interest rate expectations have changed. And remember what we said before, if yields have gone up, guys, where a bond price has gone,
Down.
So they've gone down, so you'll get a lower price then. And that's why it might be useful to you. If you're going to hold it to redemption, don't worry about it.
So that is us for the week, gents. Thank you very much for your wisdom drop yet again. If you've enjoyed what you've heard this week from the guys with that asset deep dive, then please like, subscribe, follow, tell your friends, tell your family, tune in on whatever and wherever you get your podcasts from. Again, every Friday in the afternoon, you can get us just before the European markets close. If there's any questions, where should everybody write to, gents?
The Art of Investing at IG.com.
It's almost as if we practiced it beforehand. Have a great week. We'll see you next week. Best of luck. Are we at all-time highs? Just as we launch the portfolio.
Back. This is Overtime. Chris will hopefully pop in here as the show proceeds, but we are here with Dylan Radigan in Milan. I'm Ilias Pivac in San Francisco. That's Thomas Westwater in Chicago. These markets are getting ready to wrap up the futures trading session, kind of flat. Not a whole lot going on here in the stocks space, but there is perhaps something to talk about across some of these other markets. But before we do, gentlemen, we had a chance, Chris and I, to talk about this earlier on Futures Power Hour today, but Dylan, I'd be remiss if I didn't volley this in your direction. We get some news over the weekend that apparently you can export chips to China if you are NVIDIA or if you are AMD, if you pay the government a 20% VIG. Thoughts?
I mean, so we find ourselves at an interesting intersection in global history and American politics.
That we do.
We all kind of reflexively go back to the belief that policy in America on some level, even no matter how much evidence we are presented with to the contrary, I believe most of us kind of revert back to an opinion that policy making is done on some level with a perspective or an investment or a prioritization of national interest or some perception of national interest in policy making, whether it's defense policy, whether it's industrial policy. And so when somebody says something like, well, we don't want to have this technology going to China, we sort of reflexively interpret that as well. Maybe that's not a terrible idea because they're our biggest competitor, and why should we be giving our biggest competitor access to the best technology? And you can kind of make peace with it. And then the sort of mafia piece comes into it, and you realize, you're like, hang on a second, this has nothing to do with industrial policy. This has nothing to do with national security. Basically, the entire U.S. defense and industrial infrastructure is being managed like a mafia shakedown, with absolutely no prioritization of actual national interest, no prioritization of protecting, critical intellectual property or critical cutting edge capabilities, technologically or militarily. It's simply posturing to extract fees, which is such a diminishment of the importance of the United States in the world and the importance of American technology in the world. There is a credible case to be made for being selective as to who gets access to the best American technology in a conflict-ridden and globally competitive marketplace. The credibility of that posturing collapses when basically anyone can have it as long as they pay a fee.
Well, this is the really interesting part of it, right?
Sad, honestly. It's sort of, I'm sorry, I'll wrap it up, but it makes me a little bit. It makes me, it's sort of so sad you kind of have to laugh, but you just I just feel bad for the engineers and the executives and the voters who fall into the false belief that policies are being made for the benefit of national interest when policies apparently are being made really just as a way to extract fees, which is sad.
Well, and this is really what makes this interesting, right? Because a lot of the justification and a lot of the legal framing for the executive order-based tariffs that we've had so far has been on national security grounds. And perhaps when you look at China, you might even say that kind of rationale is justified.
Yeah, you certainly can make a credible case. And if we're going to have a debate, the restrict China's access and tariff China side of the debate stage would have a very formidable offering.
That's right. I mean, obviously, justifying tariffs on European Union aluminum and steel, is tougher to sell on national security grounds. You had to go to the bottom of the national security well to try to justify them for Canada on some sort of fentanyl adjacent conversation. But with China and strange balloons showing up in U.S. airspace and the buildup of military on man-made islands in the South China Sea, all of those things, you could say, well, obviously there's a national security consideration of some kind here. And this now might serve to undercut, at least from initially a rhetorical perspective. We'll see if there is then some sort of legal action, and from a legal perspective, the logic of the tariffs, which is interesting in the sense that, of course, the deadline on those tariffs is tomorrow with China, and maybe the can gets kicked on. Thomas, do you think that this new arrangement whereby AMD and NVIDIA get to kick up to the dawn, literally, and then export these chips, do you think the markets care about this?
I don't think the markets really care about it. I think they care more about just getting access to China overall. I mean, there's this 15% levy or export fee, whatever you want to call it. China's going to get those chips no matter what. I think this imposes more of a burden on American companies, NVIDIA and AMD, for the H20 and the MI308. So it's kind of almost, I mean, not that we haven't seen it in the past few months, but like a kiss the ring moment seems to be. I mean, you say you don't want chips going there, and then they can go there for a fee. I don't know what the national security concern around that it has been if you're just going to write it off for a small fee. But I'm long NVIDIA right now, so that's one of the few equities I'm going to stay long in this market until we get past the inflation data. I just think it's going to continue to go up no matter what.
I mean, in fairness, and to your point, Thomas, you get this initial spike down on this news, then you come all the way back and you kind of settle. It's not that different if you look at AMD. And you consider, okay, well, from the market's perspective, here's your gap down, and then here's your recovery, and then backfill. So it spooks the markets initially, and then they come right back. Dylan, do you think that, sort of as Thomas is saying here, that this basically doesn't matter, and that the AI, as you've called it, supernova, just subsumes all?
I mean, I think that obviously that is my entire operating premise is that the AI supernova, that whether it's the PPI, CPI, or whether it's the tariff rigmarole, all of it sort of falls apart in the face of the supernova. And that's kind of just where I come. That's the reason I'm sort of nakedly long and sort of ignoring all of the information that would otherwise get me into a huge negative point of view. There's so many things to not believe in right now. There's so many sort of issues. I would say there's not to not believe in. There's so many reasons to be concerned about the price levels, where the market's at, all those things. And so the only reason that I hold on to my position is based on my perception of the momentum of the supernova.
Well, this is really where things get interesting. We get a little sort of bit of a baby down day today, but in looking at the supernova and sort of where we find ourselves, let's just consider we're basically sitting at the July 31st high. Mm-hmm. So we haven't gone very far in the past 2 weeks. We obviously had this very sort of alarming fade out of the Microsoft and Meta earnings. Obviously, that gave us a spike higher. This was the Fed the day before. We can see markets didn't really make much of the Fed. They were idling before, they were idling after. But then we get those huge earnings from Microsoft and Meta, and it's not like those stocks tell you something was wrong with those earnings or they were tarnished somehow. Not at all. Obviously, both of those stocks roared higher on those numbers, but the index couldn't hold it. It gapped higher, so it closed here after the Fed. It gapped aggressively higher on those earnings, then couldn't make it stick. Then we get the jobs report, which was obviously awful. And since then, we've kind of begrudgingly come back. And we're basically where we started. Now with this CPI number in front of us. The expectation is that we're going to get a 5-month high on inflation. And so what we have here then is a situation where we have to ask ourselves again, does that part of it matter? Because obviously the jobs report mattered. There it is. Earnings mattered, but then they didn't. Last week, this one little downswing before we came all the way back was a situation where we got annoying service sector data. So the market does seem to have a data issue here. And actually, it looks like Chris is back, so I think we can just bring him in and have this discussion. Production team, can we get Chris in here as we talk about CPI and just get a take around the table? There he is. Sir.
Hello.
Welcome back.
Hello, Chris.
Thank you.
We're just past the VIG to sell chips conversation and into CPI. Do jump in. Do the markets care?
About CPI or the VIG?
About CPI. I think we've collectively concluded that the AI supernova subsumes all, and while the VIG is not terribly tasty on the plate, the markets will eat it.
Markets will eat it. 85% of a pie is better than zero. And China's getting their hands on those chips anyway, right? Singapore was importing enough GPUs in a single quarter from NVIDIA that would require the entire year's electrical supply. So obviously a pass-through. And Dylan, directionally, the government's prioritizing market access as opposed to restructuring global trade or decoupling from China. I think it's great, though, for one reason. Do you want the AI infrastructure globally built on American technology or not? And that's all there's to it.
But doesn't it diminish the credibility of the American government when it claims national security reasons when it comes to things like access to military or industrial technology?
Absolutely.
Yeah.
And does
that's the part that's the part that's weird to me, as we were just saying. If you justify this whole thing on national security grounds, and China is the one place where you could really make that argument, as opposed to Canada or the EU or some such thing, is there a lawsuit? Does the American Enterprise Institute bring a lawsuit against these tariffs then?
Probably. I mean, they're being adjudicated in the court right now around IEEPA, which there is, within the statutory text, there is no mention of tariffs. So deploying tariffs under IEEPA doesn't make sense. Not really.
Seems like the business community then has a lawsuit they may want to activate because they might have standing. They might go, wait a minute, how can this be national security if there's a VIG?
Yeah, and the whole tell for me is the fact that Commerce Secretary Lutnick's kids, who are now running Cantor Fitzgerald, are selling products. Basically, hey, we know that you had that tariff bill. We'll take it off your hands for 20 cents on the dollar. We think it's going to be worth more than that. So, I mean, the Commerce Secretary's kids are
taking markets against that is unbelievable. That's a fact.
Yeah.
I think, Chris, this goes to what you said earlier on Futures Power Hour, basically characterizing this as Gilded Age again.
Yeah, I just sent the link in the chat if you want to pull it up on your screen. But this has been going around. This is only one of the sources. I just clicked the top one. But this has been in the news. It was in Wired. Wired is probably the better source to share on screen, Elia. So actually, let's do that. But Wired here reported that, yeah, his former investment bank is taking bets against the tariffs sticking around legally. So that to me is just, it's entertaining, insightful. One would have to think that a father and son talk. I certainly talk to my dad.
One would think that. And that is Wired, which is, it's not an outlet that I question the validity of, and it's behind the paywall. But the headline really says it here.
So the tariffs, to me, I mean, I think this is the most important development. We can say Trump is chickening out. I don't want to describe it as that. I think these are bad policies. What he's doing is not reordering global trade, Dylan. He's just trying to make sure that all of his billionaire buddies have higher rates of return on their capital. So why not keep the stock market pumping? I mean, it's today's obviously not a good day for stocks. We're off a little bit, but directionally, why would we take any of these tariff headlines seriously at all?
You would not. I think that's why I think the combination of the lack of, especially when you sort of completely compromise any idea that the tariffs have anything to do with national interest, and that instead the entire thing is a shakedown.
Yeah.
Between the AI supernova and the total lack of any really credible reason for the tariffs outside of shakedown art, I think it's all the more reason to stay long stocks.
Well, and this is where it gets interesting, because the wonderful thing about U.S. political and economic history, to borrow from something that Winston Churchill may or may not have said, it's certainly attributed to him, that the U.S. will do the right thing every time, having first exhausted every possible alternative. And you do get into a situation oftentimes where the legal part, the litigation component, is slower to get the right thing to happen. But sure as anything you might think, it does eventually catch up. And so this is where sort of the actions of the business community and their lobbyists, like the American Enterprise Institute, the U.S. Chamber of Commerce, and so on and so forth, this is where they kind of get their moment in the sun. Because if you because obviously they don't like tariffs, and if you compromise your own national security logic on those tariffs by opening up space for legislation to be challenged and for courts to say, actually, you can't interpret it that way, you can't do it that way, look, you're showing us that you don't mean it that way because you're creating these carve-outs, then maybe just by dint of legal procedure, as it often happens in American history, you end up with the constitutional outcome not because it's the right thing, but because eventually lawyerdom gets you there.
Well, the lawyers were going to take a look at Article 1, Section 9, Clause 5 of the Constitution, probably, when it comes to this NVIDIA AMD news, because we expressly, it's forbidden in the Constitution to apply export taxes. There's a carve out for what's known as user fees. Like, let's say I'm a business in America and I'm selling it to China, but I have to use US government aircraft to transport those goods. The government could charge me a user fee. So if I'm NVIDIA and AMD and the Trump administration offers me this deal, I go, absolutely.
Oh, yeah.
Because now the access is there and they could probably get the part struck down about the 15% tax. So, I mean, I think this directionally, they're just looking for headlines, making deals, and nothing fundamentally changes, at least for the market.
Reason to stay long, though, right? I mean, I just feel like all this is a reason to stay long stocks.
Well, that's what I'm getting at. I personally looked at the AMD and NVIDIA headline, and I felt a little crazy thinking it was bullish. But sure enough, until markets all turned lower today, SMH was the top performer. Right?
Yeah. Yeah. Yeah.
It's odd set of circumstances.
It certainly is. I guess where I depart is I don't think it's bullish. I just don't think it's bearish. I don't think it really matters. I think eventually it'll show up in the courts, this or that. I suppose it is bullish in the sense that it isn't something that creates new roadblocks. If anything, it creates some semblance of a rules of the road whereby things can get sold, and then those sales help these companies' earnings. And that's a thing. But I'm just not sure that it incrementally means anything for the broader sort of sentiment picture. I have the 8-hour chart of the NASDAQ here, and maybe this is where we can get back to CPI. We're coming off what is essentially a kind of seesaw from the August or July 31st, August 1st highs. So we had a little bit of a seesaw. We've come back. We're basically at the starting line. So nothing has changed essentially for 2 weeks.
But I mean,
we go into this thing soggy. So we can see here that there was a little intraday range, which today we took out. I wouldn't say that we've taken out the architecture of the upswing or anything like this, but we go into the CPI number soggy. Dylan?
No, I mean,
thoughts?
I was just going to say, I was sort of coming, I'm going to flip it over to sort of advocate your side, your side of the table. But I would just say that the obvious thing here would be, we know tariffs are inflationary. We know the labor market is like, set aside the supernova and the lack of credibility on American national industrial and security policy. we get a hot CPI and PPI, the rate cuts go further and further away, and the market should tank. I mean, in a rational world, this market should be set up to get its teeth kicked in.
Yes.
Between its price levels, the AI mania, all of my supernova talk, along with everybody else, the fact that tariffs are inflationary. I just don't know if it's actually going to happen. I mean, I guess do you have any insight as to how hot this number is going to be, Ilya?
In my mind, I mean, obviously nobody knows what the number is.
June was hot. June was hot.
June was hot. In my mind, what's critical here is that the markets obviously don't like economic news that either spook on growth or take you away from cutting rates, because the markets are already spooked about growth, which is why they want for the cutting of rates to commence.
And so now they got the labor market even giving them lousy numbers, which is
so they got the labor market giving them lousy numbers. That's clearly something that the markets don't like, and we'll just go straight to a daily chart to keep things simple. Here is that jobs report. Here's the Fed. Here's the markets fading those Meta and Microsoft earnings, so we can get the gap up and the fade. That's the jobs data. This is the market's selective reading of PMI numbers last week. We were saying before that the markets got a service sector PMI number from S&P Global and a service sector PMI number from ISM within 15 minutes of each other. They ignored the one from S&P Global that was strong. They fell on the one that was from ISM that was weak. So the markets want these cuts, and they don't like spooks to growth. They're spooked enough. If you look at the bond market, you can see that inflation expectations haven't really gone very far at all since they collapsed from February into the beginning of April. And so while stocks have rebounded because obviously sentiment has re-anchored, as it were, we don't have that story in bond markets, and especially in inflation expectations. So if the numbers are warmer, and they've tended to surprise a little bit warmer, both CPI and PCE on the last go-around, the PCE more so surprising because that one rarely deviates from forecasts, we have maybe the architecture of a spook. And I don't think you really have to go very far. I think, Chris, to your point, if the monthly numbers, never mind the year-on-year, the year-on-year are expected to be the highest since February, 2.8 headline, 3% core. If the month-on-month came out as expected, 0.2% headline, 0.3% core, at least on core, and that's the important one, the 3-month annualized rate would go in the wrong direction now for a second consecutive month. Those are the types of dynamics the Fed doesn't want to see. And that's if we come in line.
0.3% month over month is a 3.65% annualized rate. So you can't 0.3 several months in a row, and you start to really build up inflation pressures.
That's right.
And we should be going into the time of the year when it's a little bit more seasonally helpful, given the data series and how it's trended over recent years. Basically, you would expect inflation to bottom out in October and then flatline, and then you get a bump in January, February with all the re-anchoring, and then things just kind of chill. Yeah. But the fact that you're seeing 0.3% readings is not great. And it's one of those things that would give the Fed enough of a reason to think about a September cut, Dylan. And I think that's the risk. The market seems okay with the economic data so long as the cavalry is coming. But if Gandalf isn't coming over the hill with the Riders of Rohan and Jerome Powell on September 17th, maybe the cost of all this stuff, money's going to be more expensive for them to the future.
Isn't that exactly what tomorrow's data is about? Is the fact that September 7th could be kicked out based on the heat of these numbers?
I mean, this one, and then Ilya, we have one more before the next Fed meeting. So
That's right.
This isn't the big spook. The big one, if we had a really hot September print, that would, I think, cause a lot more problems.
That's a problem.
Yeah, that would be the bigger problem.
And I've put an oscillator on here just to kind of give a sense for dynamics. That this is RSI. It's a simpler version than what Chris would normally have on his chart, but I like my technical analysis back of the napkin crayon style. And so when you look at this, the thing that jumps out at me is that you're setting very smoothly higher highs here, and you're very clearly diverging where you're not setting those higher highs here. And that's the kind of thing that tells you momentum might be fading. Now, maybe that was already setting up for this, and we're done now, and we've reset. It could be. But this is the thing that gets you to start to worry, in my mind, is you can't come over this high. You're still holding it. You haven't been able to do it in 2 weeks, and going into it, the strength of the move seems to be getting questioned by just how much momentum is behind it. Is this a confirmed top? Of course it's not. No. But it's the kind of thing you start to see when tops begin to take root.
It's compelling, but the AI supernova cares not about an RSI indicator, Dylan.
Oh,
Radigan.
certainly not.
That is
certainly not. In fact, before you get us confused, we can table immediately any conversation that stocks will do XYZ thing because an indicator. Blah blah. Blah.
Well, I mean,
That's just not how this works.
I would say I can tell you exactly what stocks are going to do, no matter what anything is, which is they're going to go higher as a result of the ongoing supernova.
Well, so the question then is, do they go higher tomorrow? So should one just stop all this nonsense, use some futures contracts to get long into the number overnight, and then
I would say hope for a hot number, hope for a bad day tomorrow.
I see.
That would be my like if I'm just going to go fantastical, like your best case scenario is a hot inflation number jacks the market down even a percent and a half, a real beak beating, and then you get right in there and you're back on, you're in the supernova at a discount. I mean, that's sort of what I'm hoping for.
Is one day all that the sell side can manage here?
Absolutely. If maybe half a day.
Chris?
The market is, in my view, treating everything as innocent until proven guilty. Like until we have all these concerns about the big bad wolf coming. The three of us have certainly shared our own perspective on them since April.
Sure.
But until it comes, why bother? I mean, and specifically, if you're an investor, you have a very different perspective than a trader.
Yes.
So as an investor, right? Yeah, maybe the PEs are too high in the Mag 7, so you'd like to diversify, but also given the action in the market the past few days, you're seeing the Mag 7 outperform everything else. So I'm sure there's enough people sitting around saying, why am I overthinking this right now? Let's just dump all the bad stocks and buy more of the big ones. I mean, it's tough up here. I always find that the hardest part for me is always sticking around when I think a trend is going to end, when I know that I shouldn't have some preordained date in mind, and like leaning too hard on seasonality for the month of August hasn't been helpful.
I mean, thinking in general is a catastrophe.
It's been a nightmare.
And the less thinking that happens, the better off everybody is.
And there's like that 2-second window when you wake up in the morning before you think, and then you start remembering like, oh my God, I'm still me.
And then you start thinking and the whole thing falls apart.
And the whole day is just ruined.
By a bunch of thinking. Every terrible thing that ever happened, I mean, this is a long-standing fact and well-known phrase. Every bad thing that's ever happened always begins with the phrase, I thought.
And I would argue that those same people also drink a lot of water. So people who do bad things drink water. We're exploring all the causations and correlations around here today.
Is that because I'm drinking water on
We're
air?
gonna figure
Is
this
that
thing out, everybody.
Is that personal?
Here I am.
Yeah.
I had quite the adventurous day today. We drove back from West Hampton at like 6 o'clock in the morning to beat all the traffic, get the whole day out there yesterday.
Okay.
I'm not feeling too hot. My wife's saying
what time did you wake up? 5:30? 5
o'clock. 5 o'clock. Got a little exercise in, got on the road. But you know what? Something here in the side wasn't working. And they confirm, x-rays confirm sprained rib. So it's been a delightful day.
How do you sprain a rib?
You know, I did pinch a nerve in my neck reading a book earlier this year.
Okay.
So I'm just going to chalk it up to
reading.
Maybe you guys should just take me to like a farm. Dylan, next time you go up to Lake Placid, please take me upstate and shoot me behind a barn.
You got a reading injury?
We're not going into that.
If ever there was the appropriate way to sustain one. I sustained a back injury last week putting on a sock. So I think yours is better.
Come on. We can do better.
I'm going to do better. Apparently, dehydration, blah, blah, blah. I'm going to go get an IV tomorrow. I have a place nearby. It's like $150 a pop.
All right.
Just a little top me off.
Can I get you into some Tesla and some Apple?
Actually, I want to talk about Intel, if that's okay, Ilya, because we had the report this morning. Let's talk about the next trade, Dylan. Well, Intel was up 3.66% today, and it was higher than that earlier, right? It actually just fell short of 22.
You can see the wick right here.
Right, so it was up over 6%.
Mm-hmm.
What was the news that broke that catalyzed this? Intel CEO, who Trump's been taking shots at, is going to be going to the White House this week.
I saw that. There's a meeting.
So I think the question ahead of us is, who are going to be the next company's CEOs to go to the Oval? Because those are the stocks we should be buying right now.
So we want the White House guest list. We want the White House calendar.
Yes, and this is actually a great question for the chat.
Or for
Trump's children going to have their next, or for Latinx kids, yeah. But for the chat right now, who's going to be the next CEO to come to the White House to kiss the ring? Is it going to be another tech company? Is it going to be a big Boeing, maybe? Right? But what will that company be? Because all the Apple, NVIDIA, AMD, Intel, if not for buy the rumor, sell the news, right? This is a company that's probably going to go to the White House. We buy it beforehand. We know the day of the meeting, just in case, get rid of half the position. If it keeps going up, wonderful. If not, as traders, aren't we supposed to recognize these patterns? As ludicrous as they may be. I mean, this is straight Gilded Age stuff, and that's fine, right? Whatever. Not my cup of tea. But if that's the game that's being played, Dylan, we need to start thinking about what companies are going to go to the Oval next.
So, I mean, wasn't Tim Cook just in there giving him a golden plated
well, that one's there
or something?
We've seen that one now.
So that's not it. So it's not going to be Apple. Intel's coming in. I mean, how about a bank CEO?
Why would a bank CEO need to go in? Just asking that question. What are banks running into right now that Trump can solve?
Leverage.
So I think, well, aren't they already doing that? Like the Trump administration, it wants to avoid Basel III and all these exogenous burdensome.
We're about to nominate a Fed governor and maybe a Fed chair. There was some scuttlebutt over the weekend suggesting, strap in now, everybody, that Jim Bullard is in the conversation.
He would actually be very, very good.
What about Nike?
The Nike, Jim Bullard.
Like a Nike waiver for China might be really good for Nike. If the Nike CEO could get in there and get a China waiver.
What about ExxonMobil and Chevron? They've complained loudly that
some drilling rights.
Well, not just drilling rights. You keep talking drill, baby, drill. But if you're going to increase the cost of aluminum and steel and copper and this and that, the other thing, it's now more expensive for these companies
to stand up a rig.
To stand up a rig, to build the pipelines, which means their break-even cost per barrel of oil has to be higher than it currently is. Which then, if you're having them drill more, you're bringing down price, which maybe pushes them below the break-even rates, which are already pretty close by. The Dallas Fed Energy Survey suggests that depending upon where you're looking at the Bakken or the Permian, you're 51 to 56 right now. So a big expansion of U.S. oil production at this moment in time, given the economics and global growth backdrop, probably doesn't help. Probably doesn't help their earnings. So maybe not them, right? But they certainly could use the help. I mean, Lockheed Martin, General Dynamics, Raytheon, right? I mean, why wouldn't Ford or General Motors, if you're a company with a market cap of more than $50 billion, why not?
I mean, where I think it's probably too late to play is crypto, because it seems like we already got the news. One of the other interesting bits here over the weekend, besides the 20% VIG, was the news that we are getting a directive from the White House to set the stage for the inclusion of alternative assets, including crypto, into 401k allocations. Now, this is not a done deal. It sounds like they've been instructed to study these things. But of course, once the study comes back in the affirmative, as I suspect it would, then we start to open up retirement accounts to all manner of interesting things. We seem to have gotten something like a bounce out of it on Bitcoin here, a little bit of a gap at the weekly open. It doesn't stick seemingly because of the stronger US dollar, but the positivity is there. Is there anything else here?
I mean, isn't the rational actor short going into the CPI tomorrow? Aren't the pot odds of a hot CPI and a sell-off, despite all my supernova jibber jabber, which
100%.
I believe in.
I mean, that's how I'm thinking about it.
But it's like, but considering where the price levels are, considering the sogginess that my friend Mr. Spivak recently referenced, considering the odds are it's probably a hotter CPI than not, and considering that the whole thing's sort of keyed up on the September cut, I just feel like that, there's a 60-40 chance of making up the number, but I feel like there's a 60-40 chance that you're going to get a decline coming off this CPI out of the gate.
Ilya, doesn't the change in how companies have been treated in response to their earnings inform us that the pot odds are to be short if you're going to be directional?
I think so. And in my mind, it's as simple as just basically saying, all right, look, let's just take a very, very, very simple way of looking at this. Here's the range. There's the range top. And let's sort of guesstimate a range bottom. And you know what? Let's not even do a sloped line. Let's make it really simple. There. This is it. Now, even if you're inside this range, let's say the price just stays in here, doesn't go anywhere. You're a lot closer to here than you are to here. So if you're short here, well, it might go against you, but then you're wrong fast. You go up here and that's it. You're wrong. Bad. Get out.
But I mean, so
there's a lot less room here than there is here, even if nothing happens to take you out of.
Let's fire up the trade screen. Let's get down and dirty. What are we doing?
I mean, in my mind,
is it ES? Is it NQ?
In my mind, it's a straightforward sort of thing. So I'm doing this through the ETFs because they're smaller. And that makes the trade cheaper. But if you look at the IVs, they're very comparable. So ES, you have IV of 14. SPY, you're not that far off. Mm-hmm. Basically, the same story. Mm-hmm. So what do you do here? Well, I mean, if you look at the screen here and you take the guidance that you want lots and lots of duration to not get something wrong here that goes weird on you, okay, Let's even look to the other side of the Fed meeting, all the way out here. You could set up a very straightforward long put vertical at the money.
Wow.
At the money.
Wow.
And there's tons of liquidity here. And if you look at the risk reward, you're looking at a max loss to max gain here that's offering you tremendous risk reward. Just the spreads alone. So because vol is that cheap. And you don't have to be a genius here to go, you know what? I can risk a little, and if I'm wrong, I'm wrong. But if I'm right, I am right by a lot more. Just that simple. And your risk defined here.
I mean, Ilya, I'm thinking about even shorter term. Tomorrow, if we were looking at the 1 DTE, you could buy the 63.75 put and sell the 63.40 because the expected move into tomorrow is just short of 40 points. And if this market goes down, you're going to do quite fine. You need 25 points from here. Could we see 0.5% off on a warmer CPI number? But that begs the question, Dylan, why would there be a warmer CPI number? Aren't the books being cooked?
Ah, yes.
Once you start cooking the books, then I can't have that. Listen, then I can no longer partake in the conversation. Once I've got cooked books, how can I even have a discussion at that point?
I mean, the top headline on CNBC right now is Wall Street traders are worried about the credibility of U.S. government data.
Well, of course they'd say that, and rightfully so. We've had
That's just parroting the presidential hoo-ha.
I mean, as we've talked about, right? The BLS has told us that historically, something on the realm of 10 to 15% of a given month's data is what is called imputed. That is to say, they can't get direct observations on inputs into CPI. So they can't say, we don't know the price of cargo pants in Milwaukee, but we do know the price of chinos. We'll sub in the price of chinos because we can't get a price on cargo pants.
Are chinos even in style anymore?
Oh, absolutely.
Okay.
Sure. Now workwear, now and forever. But in any case, when we just look at all the rappers wearing Carhartt, that's all I'm saying. But anyway, when you look at the numbers now, so COVID, you got up to maybe 20%, something like this, 18, because obviously everything's closed. Everybody's off. Tough to go into stores and observe the prices of things and record that. BLS has been at 30% for the past 2 months, which is off the charts. Why? Well, a certain mercurial billionaire and his chainsaw might have something to do with all of that. But they don't have the staffing. They can't do the observations. So the numbers are going to be what they are. And maybe they're not going to be academically as rigorous as you might expect. But does that matter? We said last week on this very show that what the markets want is a common yardstick, and they will have that. So do the markets really care, Chris?
But if it's a common yardstick that half the market participants think is unreliable. I mean, I go back and forth on this. I do think that having a central point that we all pay attention to, like a Nielsen ratings, right? Whether or not those are accurate, we have enough industry built around that as an understanding of viewing habits. So yes, I am with the whole, as long as we're all looking at the same number, fine. But if I'm a hedge fund right now, if I'm a bank, why would I not have an alternative data set to look at as well?
You probably would.
Right? I would think that what's going to happen here is that if the data are ever fuddled with, it's going to be through seasonal adjustments. where there's a little bit more discretion. In terms of the actual data collection, it is what it is. And so I think as a backstop, market participants who at least pay attention to macro data will probably look to the unseasonal numbers, the non-seasonally adjusted numbers, and figure out a way to make that adjustment themselves, given how adjustments have been made in the past, if they find them to be deviating under this new BLS regime. And in that case, I have a hard time saying, let's say, Dylan, if the Trump administration suppresses, puts its thumbs on the CPI data, the bond market's not going to believe that crap for a hot minute. It will see through it because there will be enough market participants saying, how is inflation 2%? Like, I know my own grocery bill. Prices up were another 5% last month. This chair I wanted to buy, another $500 because of the tariffs. And so people will behave differently even if the data says one thing. And we've seen that in other countries, have we not? Turkey keeps trying to tell us something about their economic data, and the market keeps crushing the Turkish lira. So,
in fairness,
let's not be bringing the Turkish lira into this.
I have to. Contractually obligated.
I prefer not to. That's one of my favorite nations. Just please leave them out of it. Sorry, Ilya's trying to say something.
I mean, in fairness, Turkey has been a great example of exactly the kind of thing that we're talking about here. So let's give Chris his due.
All right,
we do have a president over there that for the longest has been saying that higher interest rates cause inflation. That's,
which is
that's
not to say they don't have a fine kebab, but we won't get into that.
The finest. One of the finest.
I think it is.
One of the finest, and many other delicious things
and
too.
a pistachio
I might
and
add.
honey dessert, if I might say.
And
what, like a baklava?
There's a variety.
There's a variety.
Baklava.
I like a good baklava.
Who doesn't?
Who doesn't?
With a nice side of Turkish coffee, fantastic.
And by the
fantastic.
way, cheaper than ever due to your lira situation, which is working to your benefit.
Dylan, you think that when I eat baklava, I import it from Turkey or I make it myself?
Listen, maybe you should spend some more time in Turkey with your friend over here. You might have a different point of view on the value of the cheap lira.
A lovely rose-flavored Turkish delight and a baklava and a coffee. Sign me up.
Well, Dylan, you've now been dispatched to receive those things for us. So next time we see you in person, we expect Turkish delights.
It'll be my pleasure.
Excellent.
I got a big sneaker deal cooking in Istanbul. I'll be be there regularly, so don't you worry about it.
Excellent.
Mm-hmm. I like the way that sounds. But
who among us doesn't have a big sneaker deal cooking in Istanbul, right?
But why not?
Who among us?
Seems like a perfectly reasonable
thing
for
an
Dylan
obvious
to do.
thing. Everybody's got one.
Yeah, you got it.
Come on.
Seems like a perfectly reasonable thing to do. We digress. When we look at the veracity of this data, it's interesting who gets punished, because the Turkey example is an appropriate one, as is the example of China, which is so transparent about the fact that they shade the numbers that they don't even bother to quell that conversation in the popular media. They might dislike references to Xi Jinping as Winnie the Pooh, but on the data, they don't even fight the accusation. Markets don't punish China for that kind of thing. So is this just a matter of scale, where Turkey's economy just doesn't have the weight? Sort of like Greece can't afford to run a bad sovereign ship, but the U.S. can.
I think that's exactly. I think that is precisely and 100% accurate. I believe that large nation states of great influence and power can do basically can do anything they want, which I believe is not something that President Trump has internalized and is utilizing to his great personal benefit.
So you become a great power theorist.
You don't have to trade Turkish assets, but you can't not be in the gravitational pull of China or the U.S. for that matter.
Mm-hmm.
Are you now becoming? Do you think the world is shifting back towards great powers? where we basically, I don't want to say like a 1984 George Orwell kind of thing where you have like Oceania and East Asia and blah, 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 blah. Well, there's only one more. But do you think we're heading into that world where like the US has its Western hemisphere and Russia is going to portend with Europe and Africa and China gets to play in East Asia?
I do think that the logic in the US is becoming Monroe Doctrine-ish, where we're basically saying this is
screwing
our
Canada and
hemisphere.
Mexico.
Yeah,
and so we're gonna beat up our neighbors in our hemisphere. You guys can beat up your neighbors in your hemisphere.
Yeah, this is ours. You can come and do business, but God help you if you try to actually lay down some roots here, which with China makes for an interesting thing because, of course, they've attempted to lay down roots in South America. We've seen this situation with the Panama Canal show in spades that we now are sort of in this Monroe Doctrine headspace where we're saying you can do whatever you want over there, but this is our thing. Don't come into our thing.
Well, Taiwan, it was nice knowing you then.
I mean, I actually think there's only two powers, which is I don't think Russia is a power. It's a.
I agree.
They're not.
They're not
nuclear. If it didn't
they think they are, but
if they didn't have nuclear weapons, you wouldn't even talk about them.
Right.
Europe could be a power, but it's not because it's not a if there was a federation of European states that was organized, it would be formidable, but it's not, so it's irrelevant. You just have China and America, and everything else is a scam or a pretense.
That is one way to end overtime today. Every other country is a scam.
Yeah. And with that, that happy note, overtime is out of time. We did, after all, get the whole gang together. That was good. Thank you, Thomas, for pinch hitting. For myself in San Francisco, Dylan Radigan in Milan, Mr. Vecchio there in New York. Don't go anywhere. We continue to talk macro here. I'll be right back with a deep dive on CPI, and this lot will be back tomorrow in just 24 hours.
And be careful reading.
Time.
No more reading injuries.
No thinking. No thinking.
Yeah, thinking, reading, bad. Supernova, good.
Good, yeah.
We get a slow start to the week, but key event risk looms ahead. Is it going to be a problem for stock markets? That's what we're going to dissect here on Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And not surprisingly, sure enough for those of you watching here, we are going to take a spotlight and shine it directly on U.S. CPI data, which is precisely the first bit of macro event risk here in front of us, and arguably the biggest for this week. Now, we're going to get some other notable points here as we go, but it is this report that is likely to set the stage for financial markets, and we're going to dissect what it may do and why. But first, let's take a look at how the markets performed last week, see if we can get a sense for the path of least resistance there. And of course, what we immediately see is a little bit of a rebound for stocks, 2.4% for the S&P, a more potent 3.6% for the NASDAQ. Yields nudge up a little bit. Of course, the previous week we see red all across the board, and that's in the wake of those very disappointing U.S. jobs figures. Last week, we got a little bit of a wobble on the S&P around disappointing U.S. ISM data. Interestingly enough, of course, that data coming to us alongside a parallel S&P global set basically tracking the exact same type of data, also service sector PMIs, and the market pointedly ignored those. But we can see that those sorts of things didn't really have staying power. And so we end up with a little bit of a rebound in yields, a little bit of a rebound in stocks, as we basically shrug off those figures and get back to what is essentially the starting line for the month on stock markets. In fact, we'll jump a little bit ahead here just to get a sense for what's going on and have a look at the S&P 500 here. This is the baseline September contract here, the ES contract for the S&P 500, and we can see here's where we started this month, and here's where we are now. We're essentially in the very same range where we started to idle here, just ahead of that high at 64.58.50 on the September contract. And we can see here, as we get ready to make this turn lower into this support at about 62.41, this band that's been holding us up since the beginning of July, what is it that we find? Here's the last Fed meeting that ultimately doesn't do anything. Here's the fade on those Meta and Microsoft earnings. We got the gap higher. That's where we got the record high. But we don't manage to make hay of it. In fact, we end the day lower once those numbers are subsumed. We also get this divergence with RSI, or you can pick your oscillator, but when you get higher highs on the price that don't get matched with higher highs on the oscillator, that just from an arithmetic perspective tells you momentum is fading. No rocket science there. RSI is just the ratio of closes up to closes down. And so if you're setting higher highs, but you're losing capacity to close up relative to down, this is third grade math now, momentum is ebbing. And maybe that's because we've settled into a sideways sort of a situation rather than a nakedly upward sloping one. That much is unclear, but we can see there's the jobs report. That's what gives us this hit back into the range. And then this little red bar there, that's those numbers on the service sector last week. Since then, we can see we've clawed back up and we're back into this decision point. Now, looking at some of these other assets last week, crude oil swinging lower, but not really going anywhere from the midpoint of its multi-month range. Gold a little bit higher, but again, at the top of its multi-month range, and in today's session recoiling in the opposite direction. A little bit more life in currencies not named the US dollar after last week's very impressive dollar rally despite the headwinds from that jobs data. We get a 1.1% rise in the euro. The yen is flat. Bitcoin, though, does manage a 3% gain. Now to the data, because the question from here, of course, seems to hinge on it. And the expectation is that headline inflation, the headline consumer price index, will rise to 2.8% year on year. That will be the highest since February. Likewise, for the core number, that's expected to rebound back to 3%. Again, the highest since February, so a 5-month high on both fronts. And of course, what matters most to markets from this perspective is what this will mean for Fed policy expectations, which we can see here give us 50 basis points in rate cuts for this year, 67 for next year. Now, that's at least 3 cuts and about a 68% chance, or at least 2 cuts and at least a 68% chance of a third for next year, and almost exactly 2 cuts, that extra 1 basis point we can chalk up to a rounding error, for this year. So, how does that compare with the Fed's own outlook? Well, it's exactly in line with what we have on the menu for the Fed for this year. The median rate now, 4.4%. That's the midpoint between the 4.5 and 4.25 that are the bounds of the Fed's target range. And we're looking for a move from 4.4 to 3.9. That's 50 basis points. So the Fed is in line with what the markets have on the menu here. And that much seems to be relatively well anchored. In fact, if we look here, we can see basically since the beginning of the year, this is where we've been. The floor has been 50 basis points. We've flirted with as little as 25 basis points very briefly recently, but we're generally anchored right here. And when the Fed set this forecast back at the start of the year, which was right around here, we can see that we veered a little bit here and there, but we've generally remained in this area. The real movement and the real disparity, which seems to tell you where the market's head is and what it wants to see, is in the outlook for 2026. Because we can see that here we've increasingly opened up a wedge. And while the Fed only has 25 basis points from 3.9 to 3.6 for next year, that's a single cut only, the markets have this, as we just said, at least 2 with a high probability of 3. So clearly the markets want to see more rate cuts and think that 50 basis points now, only 50 basis points, amounts to dithering. And that the markets are going to want more, that the economy is going to need more, and that the Fed is ultimately going to give them more when it comes to next year. Now, if we look at where this type of thing starts to clash with the Fed's thinking, it isn't difficult to find. So here's the June breakdown, and we can see this looks refreshingly normal. The headline going up, the core going up, and most of it still in the service sector, where that's a tad bit warmer. But most inflation is still in the spot where the Fed would want to see it. Of course, the Fed has been reluctant to cut rates because it is worried that what these new tariffs will do, that the Trump administration has been rolling out since the beginning of the year, is create an inflationary shock, whereby you get essentially a consumption tax applied to imports. Now those imports have a higher sticker price. Consumers don't buy them. That slows down overall consumption, which then slows down the economy, and you get the unfavorable mix of weak growth with higher prices. And indeed, if you look at what is actually in these Fed forecasts from June, you get that sense. We see growth projections here revised lower, whereas inflation expectations are revised higher. So this is why the Fed ostensibly isn't cutting rates. At least that's the logic that Chair Powell and company have unfurled for us in recent months. And so it is here that June's numbers start to look a bit worrying. Take away this food and energy because, first of all, these contributions don't really meaningfully change for food, and for energy they change, but mostly just because a negative number becomes a smaller negative number. And in any case, the Fed doesn't really have much agency over these things. They're set in global markets. The Fed is more so focused on core. But this starts to paint a picture. And it seems small because, of course, most inflation is still buried on the services side. But when you look at the month-on-month changes in the contribution, this is where you start to get perhaps a bit of a concern. Almost all of the increase in core CPI looks like it comes from the goods side, whereas the services side is very soggy. So this 0.1 of a percentage point contribution to overall core CPI, this increase, it comes from the part of the structure here where tariff-based inflation would be. And perhaps it is early days yet. We'll see, of course. Last month we saw that PPI numbers were painting us a picture where we had a situation that was hardly supportive because there was evidence there that the tariff-based inflation is in fact here, but what we don't see is full pass-through because wholesalers at the front end of the curve are essentially eating that inflation, absorbing it into margins, and insulating markets downwind from that impact. So insulating consumers, insulating final stage wholesalers. But it is starting to appear, and the cracks are seemingly starting to show. So what this starts to suggest is that indeed the Fed's concerns have some credence here. And maybe if we get a hot number this go around, those concerns start to push away a September rate cut once again. Consider here the Fed's preferred way of looking at the dynamics in the story. This is 3-month and 6-month annualized CPI, both core and headline, which starts to show you what the problem is. So on the bottom here are the monthly changes in both headline and core, and we can see that with these changes running at about 0.25%, we're starting to see that these higher frequency indications are trending in the wrong direction. So you can see from May to June, the 3-month annualized goes up. Ditto for core. You can see that the 6-month rates have seemingly stopped falling, or almost, after this deceleration that we've seen since the beginning of the year. So it seems like if we were to get even slightly warmer numbers, in the case of core, we're looking for a 0.3% change this time, 0.2% for headline. Even if we were to get numbers roughly in line with forecasts, still, these dynamics would be going the wrong way for a second consecutive month. And that's not the kind of thing that the Fed is likely to take with a grain of salt. That's the kind of thing that may start to tell the markets, well, the Fed is seeing exactly the kind of inflation it doesn't want to see. It isn't going to jump the gun. Now, as it stands, the likelihood of a rate cut in the September meeting is still commanding, 86.4% against expectations of no change at 13.6%. And we're almost fully discounted for a second cut either in October or December. Markets aren't quite sure which one it is. It's about a 50-50 shot on either. But they do expect that at one of those meetings, there will be another cut. Interestingly, in the wake of that data on U.S. jobs, this sell-off right here, the case for a September cut fell off the board and really has only rebuilt once we've recovered from these losses. But it was very clear that what the markets didn't want to see was that rate cut go away. And so when we start to look at this in context, we say, okay, well, if the jobs data put the rate cut back, but ahead of it, it wasn't there, or at least the markets got to a less than even chance that it would arrive. That's after this hawkish Fed announcement. What might happen here were the numbers a little bit warmer versus a little bit cooler than expected? Well, we can see that on the cooler side of things, stocks do not want a growth scare. Perhaps not even the increase in rate cut odds then is necessarily supportive if the numbers are bad enough. But that seems like an edge case. The likelier scenario is we get something closer to forecasts or something on the warm side, at least if the recent surprises on inflation data elsewhere hold. Certainly the ISM numbers that we saw last week still pointed to very potent inflationary forces, in particular in the service sector, which is, of course, the largest component of the economy. The price growth component there gave us the highest inflation reading that we'd seen in quite a long time. As a matter of fact, the highest since October 2022. Now, we did get a little bit of a slowdown in service sector price growth, but we're still very, very elevated there relative to history. And so there does seem to be quite a bit of inflation that's still in the hopper. And if the markets get the sense that that there's enough of it here for the Fed to be concerned, well, then they probably won't love it. And so this is where things may well get interesting. It could be that while we're back at these highs, the top of this range ends up holding. It's the flip side for the US dollar, which has been attempting to carve out something of a bottom since the beginning of July. It's had some pullbacks along the way, of course, but what we find is a series of higher highs and higher lows on the dollar index. This is a basket of major currencies against the US dollar, and because this basket was created before there was a euro, many of its legacy currencies are now the euro, and so in practical terms, this is basically just the euro exchange rate upside down. Nevertheless, it is showing signs that after this extended dollar decline since the very beginning of the year and into the mid-year point, that perhaps something is changing. And if in fact we get a CPI number that's a little bit warmer and these rate cut odds move even incrementally downward for September. So let's say we get from 86 maybe closer to 60. Still better than even odds of a cut, but just less convincingly so. Then one might expect a pullback on stocks. One might also expect an extension higher on the dollar, both as its yield advantage is reinforced against the other major currencies, but perhaps even more potently on risk aversion grounds. One of the biggest stories for the dollar, and really the essence of this decline since the beginning of the year, has been this idea that if you have the world's commercial currency facing a potent deglobalization push, well, then there's less trade and therefore less use for the currency. But if that part of the story is getting increasingly shelved as you get some clarity on these tariffs, a handful of trade deals, maybe a kicking of the can on the conversation between the US and China when that deadline comes up, incidentally tomorrow, then perhaps those headwinds for the dollar have been spent. And we are now going to get back to a dollar that, because of its unrivaled liquidity, benefits at times of risk aversion, yields or no yields. And so perhaps we are looking at a turn in stocks. That's a difficult thing to bet on, if only because stocks don't like going down. But however this pans out, what you may have, absent a very robust risk-on response, perhaps, because rate cuts are coming, but they are not an emergency, and they're not necessary to avert some sort of real disaster. Short of that, what you do have is perhaps a tradable bottom in the US dollar that's increasingly making itself known. And that is Macro Money for today. As ever, we are here right after Overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm likewise writing for the News and Insights portion of tastylive.com, commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading. Back. This is Overtime. Chris will hopefully pop in here as the show proceeds, but we are here with Dylan Radigan in Milan. I'm Ilya Spivak in San Francisco. That's Thomas Westwater in Chicago. These markets are getting ready to wrap up the futures trading session, kind of flat. Not a whole lot going on here in the stocks space, but there is perhaps something to talk about across some of these other markets. But before we do, gentlemen, we had a chance, Chris and I, to talk about this earlier on Futures Power Hour today. But Dylan, I'd be remiss if I didn't volley this in your direction. We get some news over the weekend that apparently you can export chips to China if you are NVIDIA or if you are AMD, if you pay the government a 20% VIG. Thoughts?
I mean, so we find ourselves at an interesting intersection in global history and American politics.
That we do.
We all kind of reflexively go back to the belief that policy in America on some level, even no matter how much evidence we are presented with to the contrary, I believe most of us kind of revert back to an opinion that policy making is done on some level with a perspective or an investment or a prioritization of national interest or some perception of national interest in policy making, whether it's defense policy, whether it's industrial policy. And so when somebody says something like, well, we don't want to have this technology going to China, we sort of reflexively interpret that as well. Maybe that's not a terrible idea because they're our biggest competitor, and why should we be giving our biggest competitor access to the best technology? And you can kind of make peace with it. And then the sort of mafia piece comes into it, and you realize, you're like, hang on a second, this has nothing to do with industrial policy. This has nothing to do with national security. Basically, the entire U.S. defense and industrial infrastructure is being managed like a mafia shakedown, with absolutely no prioritization of actual national interest, no prioritization of protecting, critical intellectual property or critical cutting edge capabilities, technologically or militarily. It's simply posturing to extract fees, which is such a diminishment of the importance of the United States in the world and the importance of American technology in the world. There is a credible case to be made for being selective as to who gets access to the best American technology in a conflict-ridden and globally competitive marketplace. The credibility of that posturing collapses when basically anyone can have it as long as they pay a fee.
Well, this is the really interesting part of it, right?
Sad, honestly. It's sort of, I'm sorry, I'll wrap it up, but it makes me a little bit. It's just, it makes me, it's sort of so sad. You kind of have to laugh, but you just I just feel bad for the engineers and the executives and the voters who fall into the false belief that policies are being made for the benefit of national interest when policies apparently are being made really just as a way to extract fees, which is sad.
Well, and this is really what makes this interesting, right? Because a lot of the justification and a lot of the legal framing for the executive order-based tariffs that we've had so far has been on national security grounds. And perhaps when you look at China, you might even say that kind of rationale is justified.
Yeah, you certainly can make a credible case. And if we're going to have a debate, the tariff, the restrict China's access and tariff China side of the debate stage would have a very formidable offering.
That's right. I mean, obviously, justifying tariffs on European Union aluminum and steel, is tougher to sell on national security grounds. You had to go to the bottom of the national security well to try to justify them for Canada on some sort of fentanyl adjacent conversation. But with China and strange balloons showing up in U.S. airspace and the buildup of military on man-made islands in the South China Sea, all of those things, you could say, well, obviously there's a national security consideration of some kind here. And this now might serve to undercut, at least from initially a rhetorical perspective. We'll see if there is then some sort of legal action, and from a legal perspective, the logic of the tariffs, which is interesting in the sense that, of course, the deadline on those tariffs is tomorrow with China, and maybe the can gets kicked on. Thomas, do you think that this new arrangement whereby AMD and NVIDIA get to kick up to the dawn, literally, and then export these chips, do you think the markets care about this?
I don't think the markets really care about it. I think they care more about just getting access to China overall. I mean, there's this 15% levy or export fee, whatever you want to call it. China's going to get those chips no matter what. I think this imposes more of a burden on American companies, NVIDIA and AMD, for the H20 and the MI308. So it's kind of almost, I mean, not that we haven't seen it in the past few months, but like a kiss the ring moment seems to be. I mean, you say you don't want chips going there, and then they can go there for a fee. I don't know what the national security concern around that it has been if you're just going to write it off for a small fee. But I'm long NVIDIA right now, so that's one of the few equities I'm going to stay long in this market until we get past the inflation data. I just think it's going to continue to go up no matter what.
I mean, in fairness, and to your point, Thomas, you get this initial spike down on this news, then you come all the way back and you kind of settle. It's not that different if you look at AMD, and you consider, okay, well, from the market's perspective, here's your gap down, and then here's your recovery, and then backfill. So it spooks the markets initially, and then they come right back. Dylan, do you think that, sort of as Thomas is saying here, that this basically doesn't matter and that the AI, as you've called it, supernova, just subsumes all?
I mean, I think that obviously that is my entire operating premise is that the AI supernova, that whether it's the PPI, CPI, or whether it's the tariff rigmarole, all of it sort of falls apart in the face of the supernova. And that's kind of just where I come. That's the reason I'm sort of nakedly long and sort of ignoring all of the information that would otherwise get me into a huge negative point of view. There's so many things to not believe in right now. There's so many sort of issues. I would say there's not to not believe in. There's so many reasons to be concerned about the price levels, where the market's at, all those things. And so the only reason that I hold on to my position is based on my perception of the momentum of the supernova.
Well, this is really where things get interesting. We get a little sort of bit of a baby down day today, but in looking at the supernova and sort of where we find ourselves, let's just consider we're basically sitting at the July 31st high. Mm-hmm. So we haven't gone very far in the past 2 weeks. We obviously had this very sort of alarming fade out of the Microsoft and Meta earnings. Obviously, that gave us a spike higher. This was the Fed the day before. We can see markets didn't really make much of the Fed. They were idling before, they were idling after. But then we get those huge earnings from Microsoft and Meta, and it's not like those stocks tell you something was wrong with those earnings or they were tarnished somehow. Not at all. Obviously, both of those stocks roared higher on those numbers, but the index couldn't hold it. It gapped higher, so it closed here after the Fed. It gapped aggressively higher on those earnings, then couldn't make it stick. Then we get the jobs report, which was obviously awful. And since then, we've kind of begrudgingly come back. And we're basically where we started. Now with this CPI number in front of us. The expectation is that we're going to get a 5-month high on inflation. And so what we have here then is a situation where we have to ask ourselves again, does that part of it matter? Because obviously the jobs report mattered. There it is. Earnings mattered, but then they didn't. Last week, this one little downswing before we came all the way back was a situation where we got annoying service sector data. So the market does seem to have a data issue here. And actually, it looks like Chris is back, so I think we can just bring him in and have this discussion. Production team, can we get Chris in here as we talk about CPI and just get a take around the table? There he is. Sir.
Hello.
Welcome back.
Hello, Chris.
Thank you.
We're just past the VIG to sell chips conversation and into CPI. Do jump in. Do the markets care?
About CPI or the VIG?
About CPI. I think we've collectively concluded that the AI supernova subsumes all, and while the VIG is not terribly tasty on the plate, the markets will eat it.
Markets will eat it. 85% of a pie is better than zero. And China's getting their hands on those chips anyway, right? Singapore was importing enough GPUs in a single quarter from NVIDIA that would require the entire year's electrical supply. So obviously a pass-through. And Dylan, directionally, the government's prioritizing market access as opposed to restructuring global trade or decoupling from China. I think it's great, though, for one reason. Do you want the AI infrastructure globally built on American technology or not? And that's all there's to it.
But doesn't it diminish the credibility of the American government when it claims national security reasons when it comes to things like access to military or industrial technology?
Absolutely.
Yeah.
And does
that's the part that's the part that's weird to me, as we were just saying. If you justify this whole thing on national security grounds, and China is the one place where you could really make that argument, as opposed to Canada or the EU or some such thing, is there a lawsuit? Does the American Enterprise Institute bring a lawsuit against these tariffs then?
Probably. I mean, they're being adjudicated in the court right now around IEEPA, which there is, within the statutory text, there is no mention of tariffs. So deploying tariffs under IEEPA doesn't make sense. Not really.
Seems like the business community then has a lawsuit they may want to activate because they might have standing. They might go, wait a minute, how can this be national security if there's a VIG?
You know, and the whole tell for me is the fact that Commerce Secretary Lutnick's kids, who are now running Cantor Fitzgerald, are selling products. Basically, hey, we know that you have you had that tariff bill. We'll take it off your hands for 20 cents on the dollar. We think it's going to be worth more than that. So, I mean, the Commerce Secretary's kids are
taking markets against that is unbelievable. That's a fact.
Yeah.
I think, Chris, this goes to what you said earlier on Futures Power Hour, basically characterizing this as Gilded Age again.
Yeah, I just sent the link in the chat if you want to pull it up on your screen. But this has been going around. This is only one of the sources. I just clicked the top one. But this has been in the news. It was in Wired. Wired is probably the better source to share on screen, Elia. So actually, let's do that. But Wired here reported that, yeah, his former investment bank is taking bets against the tariffs sticking around legally. So that to me is just, it's entertaining, insightful. One would have to think that a father and son talk. I certainly talk to my dad.
One would think that. And that is Wired, which is, it's not an outlet that I question the validity of, and it's behind the paywall. But the headline really says it here.
So the tariffs to me, I mean, I think this is the most important development. We can say Trump is chickening out. I don't want to describe it as that. I think these are bad policies. What he's doing is not reordering global trade, Dylan. He's just trying to make sure that all of his billionaire buddies have higher rates of return on their capital. So why not keep the stock market pumping? I mean, it's today's obviously not a good day for stocks. We're off a little bit, but directionally, why would we take any of these tariff headlines seriously at all?
You would not. I think that's why I think the combination of the lack of, especially when you sort of completely compromise any idea that the tariffs have anything to do with national interest, and that instead the entire thing is a shakedown.
Yeah.
Between the AI supernova and the total lack of any really credible reason for the tariffs outside of shakedown art, I think it's all the more reason to stay long stocks.
Well, and this is where it gets interesting, because the wonderful thing about U.S. political and economic history, to borrow from something that Winston Churchill may or may not have said, it's certainly attributed to him, that the U.S. will do the right thing every time, having first exhausted every possible alternative. And you do get into a situation oftentimes where the legal part, the litigation component, is slower to get the right thing to happen. But sure as anything you might think, it does eventually catch up. And so this is where sort of the actions of the business community and their lobbyists, like the American Enterprise Institute, the U.S. Chamber of Commerce, and so on and so forth. This is where they kind of get their moment in the sun. Because if you because obviously they don't like tariffs, and if you compromise your own national security logic on those tariffs by opening up space for legislation to be challenged and for courts to say, actually, you can't interpret it that way, you can't do it that way, look, you're showing us that you don't mean it that way because you're creating these carve-outs, then maybe just by dint of legal procedure, as it often happens in American history, you end up with the constitutional outcome not because it's the right thing, but because eventually lawyerdom gets you there.
Well, the lawyers were going to take a look at Article 1, Section 9, Clause 5 of the Constitution, probably, when it comes to this NVIDIA AMD news, because we expressly, it's forbidden in the Constitution to apply export taxes. There's a carve out for what's known as user fees. Like, let's say I'm a business in America and I'm selling it to China, but I have to use US government aircraft to transport those goods. The government could charge me a user fee. So if I'm NVIDIA and AMD and the Trump administration offers me this deal, I go, absolutely.
Oh, yeah.
Because now the access is there and they could probably get the part struck down about the 15% tax. So, I mean, I think this directionally, they're just looking for headlines, making deals, and nothing fundamentally changes, at least for the market.
Reason to stay long, though, right? I mean, I just feel like all this is a reason to stay long stocks.
Well, that's what I'm getting at. I personally looked at the AMD and NVIDIA headline and, I felt a little crazy thinking it was bullish. But sure enough, until markets all turned lower today, SMH was the top performer. Right?
Yeah. Yeah. Yeah.
It's odd set of circumstances.
It certainly is. I guess where I depart is I don't think it's bullish. I just don't think it's bearish. I don't think it really matters. I think eventually it'll show up in the courts, this or that. I suppose it is bullish in the sense that it isn't something that creates new roadblocks. If anything, it creates some semblance of a rules of the road whereby things can get sold, and then those sales help these companies' earnings. And that's a thing. But I'm just not sure that it incrementally means anything for the broader sort of sentiment picture. I have the 8-hour chart of the NASDAQ here, and maybe this is where we can get back to CPI. We're coming off what is essentially a kind of seesaw from the August or July 31st, August 1st highs. So we had a little bit of a seesaw. We've come back. We're basically at the starting line. So nothing has changed essentially for 2 weeks.
But I mean,
we go into this thing soggy. So we can see here that there was a little intraday range, which today we took out. I wouldn't say that we've taken out the architecture of the upswing or anything like this, but we go into this CPI number soggy. Dylan?
No, I mean,
thoughts?
I was just going to say, I was sort of coming, I'm going to flip it over to sort of advocate your side, your side of the table. But I would just say that the obvious thing here would be, we know tariffs are inflationary. We know the labor market is like, set aside the supernova and the lack of credibility on American national, industrial, and security policy. We get a hot CPI and PPI, the rate cuts go further and further away, and the market should tank. I mean, in a rational world, this market should be set up to get its teeth kicked in.
Yes.
Between its price levels, the AI mania, all of my supernova talk, along with everybody else, the fact that tariffs are inflationary. I just don't know if it's actually going to happen. I mean, I guess do you have any insight as to how hot this number is going to be, Ilya?
In my mind, I mean, obviously nobody knows what the number is going to be.
June was hot. June was hot.
In my mind, what's critical here is that the markets obviously don't like economic news that either spook on growth or take you away from cutting rates, because the markets are already spooked about growth, which is why they want for the cutting of rates to commence.
And so now they got the labor market even giving them lousy numbers, which is
so they got the labor market giving them lousy numbers. That's clearly something that the markets don't like, and we'll just go straight to a daily chart to keep things simple. Here is that jobs report. Here's the Fed. Here's the markets fading those Meta and Microsoft earnings, so we get the gap up and the fade. That's the jobs data. This is the market's selective reading of PMI numbers last week. We were saying before that the markets got a service sector PMI number from S&P Global and a service sector PMI number from ISM within 15 minutes of each other. They ignored the one from S&P Global that was strong. They fell on the one that was from ISM that was weak. So the markets want these cuts, and they don't like spooks to growth. They're spooked enough. If you look at the bond market, you can see that inflation expectations haven't really gone very far at all since they collapsed from February into the beginning of April. And so while stocks have rebounded because obviously sentiment has re-anchored, as it were, we don't have that story in bond markets, and especially in inflation expectations. So if the numbers are warmer, and they've tended to surprise a little bit warmer, both CPI and PCE on the last go-around, the PCE more so surprising because that one rarely deviates from forecasts, we have maybe the architecture of a spook. And I don't think you really have to go very far. I think, Chris, to your point, if the monthly numbers, never mind the year-on-year are expected to be the highest since February.